Right now, we're witnessing a fundamental repricing.
The market has got, to some extent, I would say, desensitized to the daily gyrations in the numbers.
The markets have been very tolerant to a lack of concrete tariff progress.
Tariffs at this point in time, I think, are just overstated. The fear is more important than the fact.
Ultimately, we will break to new highs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday, nothing good comes easy.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
Trade talks between the United States and China enter a second day in London as the US signals a willingness to remove restrictions on some tech exports. Officials are still pushing China to ease limits on shipments of rare earths. We're gearing up for another full day of talks in the British capital.
And I think it's important to emphasize that this is just on rare earth metals and technology. It underscores and it's a reminder that the process of getting through all of the trade issues, the full slate, is going to take some time. The fact that here we are on day 2, and you're only really hearing from the U.S. side saying we're making progress. From the Chinese side, it's we're staying principled.
And they've been very quiet. We've talked a lot about this over the last several months or so. It feels like we're escalating just for the sake of de-escalating. We're taking one step back and then taking one step forward. But ultimately, these talks have gone nowhere. And I think of the president's first term, it took 18 months to make a phase 1 deal. How much more of this can we take?
And at that point, they were just dealing with China, too. Recall that we also have in July the 90-day pause for reciprocal tariffs coming up, too. But it begs the question of who has the upper hand at this moment. We heard from the Huawei founder saying, actually, U.S. tech isn't that important to us. For the U.S., rare earth metals are so critical to things like the auto industry. So maybe the U.S. has more to lose in these conversations.
How nice is this, Danny? It's all relative, but it feels like a summer Monday into a summer Tuesday. Tight trading ranges, narrow stuff.
Go to the beach kind of day, which I think we would all appreciate. But you can't really relax when you have these trade talks going on. You have U.S. CPI tomorrow, and you have a 10 and 30-year auction on the slate. There's a lot that could upend these very calm markets.
We'll take a summer Tuesday into Wednesday. To Danny's point, CPI into Thursday, PPI. 10-year supply coming tomorrow, 30-year supply coming a day after. A lot still to come this week. Equity futures at the moment just about unchanged on the S&P 500. No drama there. Coming up this hour, we'll catch up with Sundar of JPMorgan as stocks post back-to-back gains. We'll also catch up with the former Trump White House trade official, Kalutkiewicz, and Michael Eng of Goldman Sachs as Apple fails to impress. We begin this hour with our top story. White House officials striking an optimistic tone as US-China trade talks continue for a second day. Annmarie joins us now from Lancaster House on day 2. AMH, just moments ago, right behind you, US officials entered that room. What can we expect from day 2?
That's right. Moments ago, they entered the room. The Chinese delegation, the U.S. delegation, we're about 20 minutes into day 2 of these talks, Jonathan. I quickly caught up with Commerce Secretary Howard Lutnick. Remember, he's in addition to these talks. He was not present in Geneva, and he said the talks are going well, and he expected the talks to happen all day long. We were outside Lancaster House till about 8:30 local time yesterday evening. They had food brought in. The talks went all day, more than 6 hours, but they still left without an agreement, and that is why we are here at day 2. There is a timeline, a time frame that they need to wrap up these talks, though, because Secretary Bessent is due on Capitol Hill tomorrow in Washington, D.C. to testify before the House Ways and Means Committee in Congress. So he has really a clock that he needs to hit today. We're still looking for the parameters of this deal, though the president yesterday, speaking to our very own Tyler Kendall at the White House, saying that basically leaving it open-ended. Not sure yet exactly how far he's going to go on easing some of those export controls. Our understanding is some of those restrictions are more the new restrictions. Things like chip design software, nuclear materials, jet engine parts, not going to the line of potentially a red line for the United States of the H20 NVIDIA chips that obviously Beijing, Jonathan, and Danny are still trying to get their hands on.
Annmarie, just build on some of this. Progress. Define the word progress. Are we making progress relative to where we were last week, or making progress to where we were back a few weekends ago when we had talks in Geneva?
It's a great question. We need to put some context around that. We're making progress on where we were just a few weeks ago when Secretary Bessent said talks stalled. And then, of course, there was that phone call between President Xi and President Trump that really opened up the pathway to have these talks at Lancaster House in London between the two trading teams. There's progress from the stalling. We are really not progressing, though, from those talks in Geneva. When they come out with an agreement today, it's because both sides said they were each reneging on the deal and the terms that they understood that they set in Switzerland. And Jonathan, you brought something up at the start of the show that I think we need to continuously remind our audience, especially as they see whiplash when it comes to trade headlines day in and day out. Trump's first administration, the trade war started in 2018. We didn't get a purchasing agreement when it came to the phase one deal till 2020. This is going to take a lot of time.
4Q 2026. Annmarie, thank you. Can you wait until 4Q 2026 to wrap this up?
I cannot wait. These markets, I don't think, can wait. Maybe we just get more. Maybe it'll be a good thing. Maybe we just get more days like Monday and Tuesday, and we can all relax and pull away from our terminals for a little bit.
I'll take a few of them, that's for sure. We'll have more from Annmarie later on in the programme this morning. She'll be standing close. Here's the view on Wall Street this morning. Sitara Sundar of JPMorgan Private Bank writing the following. We believe US equities are poised to make new highs over the next 12 months, driven by strong corporate earnings. Sitara joins us now for more. Sitara, good morning.
Good morning.
Can those strong corporate earnings show up and show some resilience in the face of this immense policy volatility?
I think so. Look, I think, one, the latest earnings season has been extremely resilient. I think we've seen strong earnings growth, and we've seen breadth in that earnings growth. Obviously, tech leading the earnings higher, but we've seen breadth, and we've seen strong earnings growth across the board. Now, what we're dealing with so far in this current market environment is this push and pull and tug of war between the bulls and the bears. It feels like the tale of two cities, if I can take us back to English Lit in high school, where on the bullish side, economic growth has been resilient and earnings growth has been resilient. And we believe that the more these negotiations take place and the longer that the implementation starts to get shifted even further out, it actually gives companies a lot more time to adjust their supply chains. I think we need to remember, too, that a lot has happened in post-COVID. A lot of companies, post the 2018 trade war and then also post-COVID, a lot of companies have already started to reorganize their supply chains. So that resilience is there. And the biggest thing that we try to tell our clients, though, is that at the end of the day, when we think about equity markets, they ride on earnings growth over the long run. So we need to see that durability. But we're really leaning into pockets of the market across public and private markets on portfolio resilience, which is a term I know that is used ad nauseum, and I'll admit that. However, we also impress upon clients that portfolio resilience means more than just downside protection and leaning into less correlated return streams. In the private markets, that means things like infrastructure or even areas within the relative value and macro hedge fund space. But even in the public equity markets, we're talking a lot about global diversification. That's not just going to give you downside protection, given the volatility that we're seeing so far this year, but it's also going to give you that potential for upside, given the incremental news and positive earnings growth that we're seeing within Europe and Japan as well.
Before we get to that, let's take another beat on the earnings story.
Yes.
This is the bear case. The bear case is the data and the earnings have been flattered by a pull forward. This summer we get the bill. Do you push back against that?
I do. Look, I think that there is obviously something to say about a lot of inventory and orders being pulled forward. But when we think about earnings growth over the next 12 months, we're still expecting mid-single digit earnings growth. I think when you look at the S&P 500, one of the things that we need to remember is that the markets and the economy are not always going to be the same thing. And when we look at that underlying earnings growth, about half of the S&P 500 is related to tech and tech-oriented areas. And the capital spending that we're seeing within artificial intelligence, no one is stopping, right? We're seeing all of these hyperscalers still putting in a lot of investment within CapEx. So we think that's going to shore up earnings on that front. But then also on the opposite side, those more value-oriented sectors, areas like financials and areas like banks, we're actually seeing pretty incremental progress on that front. And then trade policy and policy in general from this administration, there's two sides to that coin. There's obviously the trade policy uncertainty that we're seeing so far this year. However, the pro-business deregulation agenda is something that we still expect to see. And in the second half of the year, we actually expect to start to see those green shoots, which should shore up earnings as well.
What is the bar, especially what we get out of today's talks, that allows the market to keep rallying? Is it a very low bar or is it a high one, given we're only 2.3% away from all-time highs?
Look, I think that the bar is always high for us when we're thinking about where to put our clients' incremental dollar to work. What we're really trying to do is separate what's happening at the index level and focus on those bottoms-up opportunities. And what we are seeing is that we are very close to all-time highs, but a lot of that has still been driven by a handful of names. If you look at opportunities under the hood, let's just take even a step back. Forget what's happened so far this year. Over the past couple of years, a majority of the returns that have happened within the S&P 500 and even global equity markets has still been concentrated in the mega cap tech players. And we expect to see breadth. Now, the rising tide is not going to lift all boats. We need to be able to focus on those quality earnings compounders across, again, public and private markets, because when we think about the next cycle and the next decade, higher rates, likely going to be higher inflation, even if it comes down a little bit. So what that means is that we need to be able to find those companies with solid balance sheets that are able to weather the storm of a higher rate and higher inflationary environment.
Well, what we heard this earnings season, it was really only a handful of companies that really talked in earnest about raising prices. You had Hermes, but of course not everyone's buying a Birkin, so maybe who really cares about that? Ford talked about it. Walmart tried to talk about it, and it was shot down. Were you surprised you didn't hear more discussion of prices going higher for corporate America?
Look, I think that it's a very delicate balance in terms of forward-looking guidance, and I wasn't surprised to see that not as many companies were trying to paint what the roadmap was going to look like over the next 12 months, not just because of inflation, but there's a lot of uncertainty in the environment right now. But when we think about where to put the next dollar to work, we do think that there's going to be pass-through, that companies are going to be able to pass through a lot of the price increases down to the consumer. So what that means from our perspective is two things. One, how resilient is the consumer and therefore how resilient is the economy? We're still seeing consumer spending level strong. It's something that we're monitoring very closely. But then two, to this idea of what's going to end up happening on the inflationary front, we do believe that there's going to be volatility within inflation. So what does that mean when we think about client portfolios? We are looking for areas on that portfolio resilience point where you can even generate income that is inflation protected. I think that's probably the biggest point that I can probably make. Core fixed income obviously has a place within client portfolios. It always has. It provides that durability and that downside protection. However, we've also been incrementally talking to clients about infrastructure, where you are supported when you think about these long-term returns, long-term contracts, contractual cash flows, but cash flows that have inflation escalators embedded within them, where that yield and that income that you get ends up keeping up with inflation so that you actually have that durability.
Just a final word on that. I think you're making a really important point. A lot of people are having the same conversation. If things go wrong, will bonds bring me comfort, or do I need to look somewhere else? Are you pushing people to somewhere else?
We are pushing people to areas of the market that are going to complement the exposure that you have. Core fixed income is always going to have a place. However, when we think about the market environment moving forward, the 60-40 is likely not going to be enough. You're going to need other areas of the market that are going to be able to shore up that portfolio resilience. Infrastructure is one of those places.
Sitara, enjoyed this. It's good to catch up. Thanks for being here.
Thank you.
Sitara Sundar there of JPMorgan Private Bank. If you are just joining us, welcome to the programme. Equity futures just about unchanged on the S&P 500. It's day two of trade talks in London between the US and China. Annmarie standing by over in the British capital. We'll catch up with her a little bit later. For an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnold. Hey, Yahara.
Hi, John. The Trump administration has deployed 700 Marines to Los Angeles to respond to anti-deportation protests. Meanwhile, the state of California is suing to try to stop the deployments. President Trump backs comments from border czar Tom Homan that California Governor Gavin Newsom could be arrested if he interferes with the response. Meanwhile, as you were just discussing with Annmarie, trade negotiations between the U.S. and China are continuing for a second day in London. The U.S. signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will ease limits on rare earth shipments. Treasury Secretary Scott Bessent said they had a good meeting yesterday, and Commerce Secretary Howard Lutnick called the talks fruitful. And Apple shares ended lower yesterday as AI took a back seat at its worldwide developers conference. Instead, it focused on a new software redesign called Liquid Glass. Apple did introduce some AI-powered features, including an expanded relationship with OpenAI, which will help it match features already offered by Samsung and Google. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, nothing good comes easy.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
In just a moment, we'll catch up with the former Trump trade official, Kate Kalutkiewicz. She joins us next. Plus, we'll catch up with Bloomberg's Tyler Kendall, who was in the room with the president. Back-to-back gains on the S&P 500, looking to make it another day of gains. We're positive here by 0.1% on the S&P, on the Nasdaq up by 0.15. Under surveillance this morning, nothing good comes easy.
We are doing well with China. China's not easy.
Did you give your negotiators any sort of limitations?
We're going to see. Look, China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason. They didn't want to do it.
So here's the latest this morning. Trade talks between the US and China back on in London for day two. The Commerce Secretary Howard Lutnick telling Anne-Marie just moments ago he expects talks to go all day today after saying they were fruitful yesterday. Joining us now is Bloomberg's Tyler Kendall, who was in the room with the president yesterday afternoon. Tyler, what was your takeaway from that particular exchange?
Yeah. Hey, John. Good morning. Well, it's clear that the White House is trying to thread the needle here. We have to keep in mind that one of those preconditions for these talks to even happen was that the U.S. was going to temper its rhetoric to be more respectful when it comes to China. But it's clear that President Trump doesn't want to give up his leverage and that they are trying to pressure China when it does come to these discussions, even as officials on the ground do express optimism moving forward. And President Trump told me directly that ultimately China is, quote, not easy to negotiate with. And when I pressed him on if he gave his negotiators any sort of limitations on export controls, which is really what these talks at the moment are centered around, as you heard, he was pretty non-committal, but he also didn't rule anything out. Now, our reporting does indicate that the U.S. has signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will, of course, speed up its export licenses for rare earth materials. People familiar do tell us that the Trump administration is prepared to remove measures targeting chip design software, jet engine parts, also some nuclear materials. These really are where we saw these new restrictions go into place in recent weeks when it comes to the Trump administration. And John, at the moment, there is a lot of focus on the Commerce Secretary being there on the ground in London. But we should also point out that last week we had quite the split screen here in Washington. The same day that President Trump held his phone call with Chinese President Xi Jinping, you also had Commerce Secretary Howard Lutnick on Capitol Hill testifying to lawmakers that he actually thinks there needs to be stronger enforcement when it comes to export controls against China. So there's still a lot of issues that need to be worked out here.
Tyler Kendall with the latest in Washington. Tyler, thank you. More from Tyler in the next hour. The National Economic Council Director, Kevin Hassett, made this sound quite simple yesterday, straightforward. This will be short. Ultimately, on our side, we'll drop some tech restrictions. On their side, they'll ease some shipments of rare earths.
That's Kevin Hassett, but it might be a different question as to what exactly is happening in the room. And given it seems that these restrictions were put on recently, it seems like the Trump administration has come in with some extra pressure that they want to put on. So just how easily are they going to be willing to relinquish that control when China holds a really big chip when it comes to rare earth metals?
To have that conversation, joining us now is the former Trump trade official, Kate Kalutkiewicz. Kate, welcome back to the program. I want to lean on your experience and how you define progress in this round of talks.
Well, progress would be an outcome, as opposed to just officials that are not in London commenting on how things are going.
So an outcome, what outcome might we hope for, Kate? What might we get out of this?
Well, this is the question around which outcome both sides are hoping to achieve here. I mean, if we are really just trying to get a reaffirmation of what was already agreed to in Geneva, these should be relatively short meetings. The fact that they're dragging on longer than anticipated indicates to me that one side is perhaps dragging its feet, thinking it can get something more than just the Geneva deal.
We also are in a moment where China has been tightening its rare earth exports, not just for America, but for all countries. In order to reach some type of deal, Kate, does China need to walk away with something that the U.S. can offer that it desperately needs? Just how much does the U.S. side need to move?
Well, look, I think that the U.S. desperately needs the rare earths. That's the outcome that President Trump has sent his negotiators to get here. China, as you point out, has restricted these minerals to other nations too, but they're negotiating in parallel with the Europeans and others alongside the United States. So this isn't the only game in town. That said, the United States is under the impression that as an outcome of the Geneva talks, China agreed to release the rare earths. And so this is a bit of a he said, she said discussion. Now, what the United States has to do to get China to release these minerals remains a bit unclear. The Americans, I believe, place these new restrictions on Chinese students in the United States as a way to get the attention of the Chinese and perhaps feel that an easing of visa restrictions will be sufficient. Though China, of course, has signaled it wants more than just the visas. It wants restrictions lifted on certain AI export controls as well.
Okay, last time around in the president's first term, it took 18 months to achieve a phase one deal. And at the epicenter of that phase one deal were purchase agreements. And I wonder, Kate, from your perspective, from your vantage point, whether you think it's different this time. The ultimate end goal has changed and maybe it's going to be harder.
It's a terrific question. And I think we all remain a bit unclear about what the end goal is this time around. Now, you remember in the first Trump administration, we had a fairly lengthy investigation and public report articulating a myriad of concerns related to China's unfair trade practices, relating to forced technology transfer, IP theft, unfair subsidies. In this case, we hear from the president from time to time issues he'd like to address in China, but it's not nearly as clear. So an outcome could take as long as 18 months or longer, particularly if the ground keeps shifting as it does.
Well, let's just sit on that for a beat longer. I'm confused now. When they were making the argument they wanted to rebalance global trade and push China to drop its walls, that made perfect sense. I remember the NEC director, I'm sure you do too, Larry Kudlow, used to talk about reciprocity. But since the Biden administration, the focus appeared to be more on national security and strategic decoupling. Do you think it's more of the latter and no longer the former anymore, driving things down in Washington?
Yeah, I think that's true. I think that the shift in tone has frankly encompassed all of Washington. Both Democrats and Republicans, I think, have acknowledged this notion of strategic and economic competition with China and the need to confront the growth in critical sectors. So some of it, of course, will still be about access. President Trump has spoken quite clearly that he wants American companies to have access to the Chinese market. So I do think we will still see a focus on certain purchase commitments, certain access restrictions being lifted. But this is a much broader competition now. And I think in some ways, President Trump has brought the fight home, where we see, new measures impacting domestic manufacturing in the very critical sectors China dominates now. So as opposed to a tariff-heavy war that we saw the first time around, I think both sides are going to try these supply chain restrictions to stop the other from advancing in this long-term economic competition.
Kate, appreciate your take as always. Kate Kalutkiewicz there, the former Trump trade official. What's progress? Progress is an outcome. We'll see if we get an outcome later on this afternoon.
And hopefully it's an outcome that sticks. We had progress in Geneva, and here we are again having to have these conversations. So progress is fluid, let's say.
Equity futures right now positive by a tenth of 1%, following back-to-back gains on the S&P 500. In just a moment, we'll catch up with Isabelle, Mateos, Lago of BNP Paribas. Looking forward to this week's inflation data. CPI tomorrow, PPI coming the day after. Live from New York City this morning. Good morning. Quiet week so far. It gets busier. Tomorrow, CPI. The day after that, PPI. A couple of debt auctions in focus as well. But so far, so good. Equity futures on the S&P 500 just about unchanged. On the Nasdaq 100, positive by close to 1/10%, with 3 hours until the cash open. Let's get you some morning movers with Yahara Anand. Hey, Yahara.
Hi, John. We start with Novo Nordisk up 3% here in the pre-market on an FT report that activist hedge fund Paribas Asset Management is building a stake in the company. And they report that Paribas wants to say in who the next CEO will be, as it faces rising pressures in the booming weight loss drug market. But not booming has been this stock, which has been cut in half in the last year. Meanwhile, next up we have Taiwan Semiconductor. Those shares are up 1.6%. It posted a 40% jump in May revenue as companies rush to stockpile its chips before U.S. tariff relief expires in July. The world's top chip maker, supplier to Apple and Nvidia, brought in over $10 billion last month. And while that was down from April, TSMC says AI demand remains hot and it still outstrips supply. And we end with McDonald's here. Those shares are falling nearly 1.5% after it was hit with another analyst downgrade, this time from Redburn. Yesterday, it was Morgan Stanley, which downgraded the stock, saying that there are more headwinds ahead for its lower income diners. And then there was Loop Capital, which flagged that people were complaining about its McCrispy chicken strips, saying they don't have as much breading and that they're smaller. So they also downgraded the stock. I cannot confirm that, but happy to do market research. John?
Yahara, thank you. There's a couple of words that scare me. Food innovation. I don't want innovation on my food.
No,
I don't know about you.
What is that? Like, I don't want new chemicals, and so I just leave the science out of it. Just give me real chicken and I'm happy.
You mentioned a wrap this morning I've never heard of when you were talking about McDonald's on the program.
Yeah. Oh, a katsu wrap?
Right, a katsu wrap.
Yeah, which
in McDonald's.
It sounds delicious, but you
That's
wouldn't
a London
really.
thing.
Yeah, would you trust London McDonald's to give you a chicken katsu wrap? I'm like, maybe in Japan you go get that, but I don't know.
Probably not. Okay, we'll leave that one there. On our radar this morning, our top story. A second day of trade talks between the US and China underway in London. The US signaled a willingness to remove restrictions on some tech exports. Officials still pushing China to ease limits on shipments of rare earths.
I think it's important just to note who has the upper hand and what China is specifically doing with their rare earths. Because they're not just putting restrictions on the US. This is a global effort that they are doing. You get the sense that China realizes how crucial rare earths are and are trying to give it long-lasting leverage by really controlling the shipments, who gets it, when they get it. And for the U.S., you have an auto manufacturing industry that's so dependent on it. It is a rare bit of leverage that China has that it can really flex. So just how much does the U.S. need to cave in these talks to really accommodate that?
I don't want to predict the outcome of this. I don't think you want to either. But yesterday was framed by the NEC director, Kevin Hassett, as quite straightforward. Easy. Sure. The fact it's spilled into a second day probably speaks to the idea that maybe this is a little bit more difficult to get done.
And not only has it spilled into a second day, but the Commerce Secretary, Howard Lutnick, told Annmarie earlier this morning he expects it to go all day, too. They were there until 8 p.m. last night. He expects it to go that long at this time. And remember, it's not even this that they have to figure out. They have to figure out all of China tariffs, not just rare earth metals. They have to figure out all the reciprocal tariffs. If this one issue on itself is taking this much time, it shows just what a long road ahead they have.
The president is focused on other things, including this. The White House sending 700 Marines to Los Angeles in response to the anti-deportation protests. California Governor Gavin Newsom suing the administration for its response. And the president saying Newsom may be arrested if he interferes.
I have to say, I think this is likely the fight that Trump is more happy to take on than, say, an Elon Musk fight. Trump's approval ratings are very strong on immigration. 54% in a CBS poll going into this weekend saw him more favorable on his deportation efforts. This is something his voter base likes to see. And let's make no mistake, I think it's telling that this happened in a deep blue state, that this happened in a place that's really concerned about immigration, where you can get these images. Trump, more than anyone else, knows the power of these images and what that likely does to get his base excited about the immigration actions.
I could not agree with you more. Really couldn't. The president seems to be much more comfortable with this as a topic than, say, trade. And I think it takes some heat out of officials, or at least off officials, down in Washington on the following. House Speaker Mike Johnson pressuring Senate Republicans to preserve a deal raising the SALT cap to $40,000, pushing back on President Trump's willingness to scale back the write-off. All of a sudden, this conversation, it's not the front page, it's not the headline, it's on the back pages. The focus is on Los Angeles.
Right, because this just underscores dysfunction. But let's be honest, all of this looks to an international audience as something of instability, especially images in Los Angeles, dysfunction in D.C. It really underscores this narrative. Because what do you get if you have the Senate pushing back? It needs to go back to the House, where you have such a thin majority. In the House, you have people who care about SALT. In the Senate, you don't really have that constituency as much for Senate Republicans. So it's this back and forth and just underscores how difficult reconciliation is, even before a midterms where you might get changes to the makeup of the House and Senate.
Have we still got a self-imposed July 4th deadline?
Yeah, apparently so. Okay. And the clock is ticking down very quickly.
They themselves have called it aspirational. We'll see if they can get it done. Looking ahead to some economic data this week. CPI tomorrow, PPI the day after. Isabelle, Mateos, Lago of BNP Paribas bracing for tariffs to make their mark, saying the following. The bulk of the price impact from tariffs is still ahead of us and likely to come in full force through the summer. Isabelle joins us now for more. Isabelle, welcome to the programme. Good morning.
Good morning.
Where do you see it hitting hardest? When you think about the sources of inflation, where are you expecting this to show up?
Well, we've seen some sectoral tariffs being particularly high, so steel being a key example, automobiles. These are the high tariffs. These are the 25, 50%, but obviously it's a small part of the total imports. And then the rest is 10%. This is more likely to see corporates trying to be a bit patient in figuring out how much of it do they want to try and absorb through cost reductions or just absorbing the hit on their earnings versus passing it on to their consumers. So it will be, I think we will see the impact first in small parts of the CPI, but it will broaden out over time. And I think that's why so far the numbers haven't shown, anything massive, but it's going to creep through, I think, fairly gradually.
In the immediate aftermath of the pandemic, coming out of the pandemic, if we had this trade war then, we saw consumer balance sheets which were very strong and a labour market which was incredibly tight. And I think a lot of people would have been far more worried about second-round effects and inflation getting out of control. How different are things now sitting here in 25?
It is quite different. You're right to point that out. The consumer demand is not endlessly elastic. As you say, the labour market is still strong, but is clearly moderating, cooling down. And I think this is what you're hearing in corporate communications when they talk about their strategy to deal with these tariffs is they're going to be a little careful because they don't want to lose market share. And in fact, some are aggressively pursuing market share as part of this environment. And so I think that's why we're going to see a very gradual pass through and also more emphasis on cost control, maybe additional automation to control the cost pressure. So it's going to be really interesting to see how this pans out. But I think that doesn't mean we're off the hook in terms of risk of second round effect. That's still very much part of the picture. It's less prevalent than perhaps right after the pandemic, but it's something we need to keep in mind. And then the last point I would add, and this brings us back to the rare earth conversation, is where you could really see a very sharp price impact is if you get supply chains breakdowns because you have an essential component that is missing and all of a sudden production stops, and that's when you can see really big spikes. And I think that's why we've seen intense focus on this in the US-China talks, not so much on the tariffs, but on making sure that these rare earths keeps flowing where they need to flow so that you don't have supply chains breaking down.
The other thing that's very different from COVID and the volatility we had then was rates were taken down to zero. Rates are higher this time, and you have a Fed who's been very unwilling to suggest that we would have any cuts in force because of the unknowingness. How much pressure does that mean there are for corporate balance sheets right now? We haven't really seen defaults tick up too much, but if this period continues on, could that change?
For sure. But I think the primary concern for the Fed right now is, keeping inflation expectations as anchored as they can be. You can debate, are they fully unanchored or are they, but they certainly look a little wobbly. When inflation expectations bounce around based on, headline news, it's telling you something. So I think right now this is the number one concern for the Fed. It's not the health of corporate balance sheets. But of course, they also don't want to overdo it. And I'm sure they will want to cut as soon as they're reassured that we're not going to see second round effects, but they have a very tight path to walk.
Well, inflation expectations bouncing around, I'm assuming you're in some part referring to what we got yesterday from the New York Fed. A round trip in inflation expectations, they come down to undo the tick up you had higher in April. Do you just discount that? What do you do with something like that?
Well, no, you just notice the volatility of these inflation expectations, which is by definition means they're not anchored and they may just bounce back up if we see, if at the end of the 90-day truce we see tariffs going back up or the talks in London between US and China don't go the right way. And that is not a healthy situation. And in that situation, the central bank has to be really putting a premium on the credibility of its commitment to keeping inflation, bringing it back to target.
Andrew Honhorst of Citi was in your seat yesterday, and he said that the Federal Reserve will have to take the summer off. That maybe they start cutting interest rates in September, but basically for the rest of this summer, goodbye, let's see how this shakes out. Is that your view on things too?
At least. And in fact, I think September looks very early. I'm very doubtful we'll have any greater clarity in September. And again, they really don't have any reason to take a chance one way or the other. We need to see how quickly these tariffs are getting passed through or not. We need to see where the tariff rates land. We still don't know that. If we're at 10%, it's a very different story than if we're back at, it'll be anywhere between 20 and 40%, depending on countries. I think it's very difficult to see the Fed moving before the end of the year.
If unemployment gets to 4.5, 4.6, 4.7, and we still haven't resolved the trade story, how interesting are things then for the Fed?
Then it gets very hairy, and I wouldn't want to be in their shoes. But absolutely, that's what they're going to be looking at. But remember, the labor market is having a dynamics of its own because of, we saw in the last numbers, participation rate coming down, immigration, falling, and so you have a shrinking workforce, or at least a workforce that isn't growing as fast as it used to. And so you can have a much more tepid pace of jobs creation and the unemployment rate staying kind of where it is, which is not good news for the economy at large. It's not good news for GDP growth, but for the Fed, it means that it means a labor market that doesn't give it the weakness that it needs to cut.
I heard this a few times. The Fed needs to sit this one out
for
the summer and maybe even beyond.
I think there's probably an acknowledgement that this also isn't the Fed's battle. It's not under the control of monetary policy right now. What's happening in the world is a political economy. It's one driven by fiscal policy. So maybe just for that very reason, there's sort of a bias from the Fed to say, let's not move in here, because if we get a recession, it's not our fault.
Isabelle, it's good to see you. Thanks for dropping by. Thanks for your time. Isabelle Mateos Lago there of BNP Paribas for the Federal Reserve, focused just as much on the CPI data of Wednesday as they are on the trade talks in London. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. The UN nuclear watchdog says Iran's stockpile of enriched uranium cannot be ignored. The warning comes as the International Atomic Energy Agency's Board of Governors meets this week in Vienna. It reported last month that Iran's inventory of close to weapons-grade uranium is at record levels, growing by 50% in the last 3 months. Meanwhile, U.S. Health Secretary Robert F. Kennedy Jr. dismissed all 17 members of a key federal vaccine advisory panel, accusing them of conflicts of interest. Before joining the Trump administration, RFK Jr. was known as a vocal critic of the committee, which advises the director of the CDC and helps shape national public health guidelines. And Meta CEO Mark Zuckerberg is creating a new AI superintelligence team. Sources telling us here at Bloomberg that Zuckerberg aims to hire around 50 people for the new group. He believes Meta can beat other tech companies in achieving what's known as artificial general intelligence, or AGI, the idea that machines can perform as well as humans at many tasks. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, Apple is not at the party.
The main thing that everybody cares about is our Apple devices are dumb. Apple isn't even at this party. So what we want to see is Apple taking aggressive steps to redo their entire operating system around AI.
Did we get any of those aggressive steps yesterday? We'll catch up with Michael Eng of Goldman Sachs in just a moment. From New York, this is Bloomberg. Live from New York City, welcome back to the program. Just a flavour, a snapshot of the price action for you this morning. Good morning to you. Futures positive by 0.1% on the S&P, on the Nasdaq 100 up by 0.07. No drama there whatsoever. Under surveillance this morning, Apple is not at the party.
There is actually no real big change that was announced in this event. The main thing that everybody cares about is our Apple devices are dumb. Apple isn't even at this party. So what we want to see is Apple taking aggressive steps to redo their entire operating system around AI versus these sort of incremental attempts at making Siri better. And we just didn't get that.
So here's the latest this morning. Apple failing to impress investors at its Worldwide Developers Conference, with AI taking a backseat to a software redesign. Michael Eng of Goldman Sachs has a buy rating and 253 price target on shares of Apple. Mike joins us now for more. Mike, good morning.
Thank you for having me.
How disappointed were you yesterday? What did we hear versus what you wanted to hear?
I wasn't very disappointed at all. I think investor expectations for WWDC 25 were very low, and I think that Apple met that low bar. Apple opened up the session by conceding that the personal features that would be coming to Siri would, be delayed to the coming year, and that was largely as expected. And we got several quality of life improvements. There was a new design interface called Liquid Glass. There were some Apple Intelligence features embedded into several new features across the operating system, like live translation, a workout buddy, things of that nature. But I think they delivered some incremental improvements and inline expectations, albeit low ones, going into the event.
I think a lot of people would agree, including you, based on what I've read in your note, that this isn't sufficient to really drive massive demand into Apple iPhones. But do you see anything happening outside of Apple that would erode demand for Apple iPhones?
Yeah, I think you hit the nail on the head in the sense that investors care about Apple Intelligence to the extent that it helps to drive iPhone demand and demand for other products within the Apple suite of products. And while Apple Intelligence is an important software demand driver, there are other things as well that I think may be underappreciated right now. Some of the things that I'm excited about are some of the upcoming form factor changes. Apple's last iPhone form factor change was back in 2017 with the iPhone 10 when they got rid of the home screen button. And over the next several years, I think we'll see some very meaningful ones. This year with the slim version of the iPhone, next year the foldable, the year after that in 2027, the 20th anniversary phone where we may get an all-glass enclosure and a new design of the exterior.
Are those enough in the absence of AI to drive new demand cycles?
I think they are. I think that form factor changes are the most meaningful demand driver for consumers today. And outside of that, I think there are other things that should be helpful in helping to shorten the replacement cycle and driving demand. So in the U.S., which is just over a third of Apple's revenue, I think the rising competition among wireless carriers is helping. I just upgraded my iPhone in the last week, and I got it for free, lowered my monthly bill, and I think you're seeing more promotional activity coming out from Verizon, AT&T, and T-Mobile after those carriers enjoyed a very long period of benign competition after the T-Mobile Sprint merger.
Is there a point at which that changes? Kind of to John's point in his question, when you look at Android making really far advances where I can take a photo and I can completely redesign it with AI, is there a point where that becomes attractive enough, if Apple hasn't caught up, that users do start switching?
Absolutely. I think it's a real threat. I think at some point, some of these new software features, these AI features, could be a point of differentiation for Android and other devices. But I think at this stage, we haven't really seen that market share loss yet. The iPhone install base continues to grow every single quarter, year after year. And I think that that's the most underappreciated asset that Apple has, that 1.2 billion iPhone install base users and the over 2.3 billion, 2.4 billion across all devices.
Would it help if they stopped talking about Genmojis?
I'm not the biggest fan of Genmoji, but I'm probably not in the age demographic.
I have to say that just for investors and for analysts, it just seems frustrating. It feels like amateur hour when they start talking about combining emojis and making Genmojis. I just think in this moment, at this time, when we're looking for that serious incremental improvement in the software and what we can do, the usability of the phone, and they start talking about combining emojis on the screen, they kind of lose me pretty quickly.
I don't think there's a killer app for that's the same for everybody. I think everybody wants to use AI in their own way. So, for example, I thought the live translation tools that they announced yesterday were going to be really attractive to the vast majority of the user base. And I personally am excited about improvements to things like writing tools to help draft responses to emails and text messages beyond what's available today.
I wish they had live translation when my Italian grandparents were still around. They would have loved that. That would have been absolutely phenomenal.
You mean they wouldn't have loved you transforming yourself into a unicorn Genmoji talking to them?
No, I don't think they've been too interested in that. But I think the live translation is interesting because other people are already doing it. So it's catch up. Is there anything other people are doing, to Danny's point, anything other people are doing that Apple hasn't met just yet and needs to do?
I mean, we've seen some interesting demos of a more personal, high-powered virtual assistant coming out from other developers and applications. And, I think Siri, for the most part, hasn't delivered against that promise yet. With that being said, this Siri with more personal features and better on-screen awareness, that'll come out in the coming year. And I think those new software features will be rolled out in tandem with some of those form factor changes that are coming out in the next couple of years. So I think you've got Apple rolling out those better powered AI features along with new form factor changes for the iPhone that I think will result in a really good shortening of the replacement cycle in iPhone demand.
What about the hardware? When this VR headset came out, there was so much hype around it. You couldn't even try the things on without getting onto a wait list. It really feels like it's fallen by the wayside. Are we going to look back at that period and say it was a boondoggle, it was too soon for Apple to try to release something like that into the market?
Yeah, the numbers for the Vision Pro have certainly been fairly low and immaterial in the grand scheme of things. With that being said, I think it's a recognition that we have all this new technology in VR, AR, and AI, and perhaps there can be a new consumer product that's developed to fully utilize and embrace that new technology. And Vision Pro is an excellent example of that, as is what's potentially coming out of OpenAI and I/O. So I think it's to be determined. I think adoption of a consumer product like that at scale will certainly take some time. And I actually applaud Apple for being on the bleeding edge of innovation on the VR AR side, with the recognition that commercially it probably hasn't been as successful as investors would have liked.
Mike, in the time we have left, the focus at the moment for markets at least is on the trade talks in London. What are your base case assumptions tonight, underlying assumptions on how this shakes out between Tim Cook and President Donald Trump with regards to tariffs on iPhones?
So I don't have a magic 8-ball to figure that one out.
Neither do we.
But what I would recognize is that Apple's contemplated a level of tariffs in its current financial guidance for the June quarter, really assuming the current state of things, which is the 20% IEEPA, so-called fentanyl tariffs, and the upcoming reciprocal tariffs. And Apple's done a very good job of managing the supply chain and managing the tariff exposure that it has for iPhone and the other devices within the Apple suite. And that includes diversifying into India, where the majority of U.S. iPhone sales coming in the upcoming quarter will have a India product country of origin.
Which is something the president seems to be unhappy about. Mike, good to catch up. Appreciate your time. Michael Eng there of Goldman Sachs. Live from New York, the second hour of Bloomberg Surveillance is up next.
There's nothing simple about the U.S.-China relationship that have a number of challenges.
Both countries have identified the other as their most significant long-term strategic challenge. That's why both sides are now at the table.
The president has many goals when it comes to economic relationships.
The reality is that tariffs are here to stay. The only thing we're debating is what's the magnitude and in what form is it actually unleashed onto markets.
Good agreement, neither side's going to get everything they want. So they're going to have to give in on some things. What are the red lines?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning, good morning to all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Equity futures just about positive following back-to-back gains on the S&P. We're positive by not even 0.1%. Likewise on the Nasdaq 100, a quiet start to the week. We'll take it. It gets busier as this week grows older. CPI tomorrow, PPI the day after that, and two very important debt auctions coming up later in the week.
It just underscores that sentiment has improved so much, but there are so many catalysts that could change that. When you have a New York Fed consumer inflation expectation survey come back and inflation expectations are back down, you have the sell side upgrading left and right what they see as their expectation. The S&P 500 2.3% away from all-time highs, and yet we are in London, day two, and no agreement has been reached on rare earths and tech exports. It is such a long road ahead, but already there's so much optimism priced into risk assets.
Let's talk about that optimism. Lisa Shannon of Morgan Stanley said this is a rally looking for a credible narrative. She doesn't think there is one. We've had a rally of more than 20% off the April low. What's the narrative to drive us a step higher from here through the summer?
Every day it's something different. The latest one that this market seems to wraps its hands around is tech. The latest flows, Citi pointing this out, it's basically all going into tech. That all of a sudden we're back in this environment where if you're unsure if CapEx is going to continue, if things look icy, the one place that is spending and spending massively, it is the technology. It is the hyperscalers sending billions after billions trying to invest. So it is a market that keeps coalescing around big tech.
It's like JPMorgan said, it's the twin pain trade, an equity market that keeps grinding higher and narrower leadership coming out of, Danny said it, coming out of tech. Equity futures this morning, barely positive. Let's set you up for the hour. In just a moment, we'll catch up with Matt Miskin of Manulife, John Hancock Investments as stocks post a two-day winning streak. Henrietta Treyz of Veda Partners with US-China trade talks continuing. And David Tinsley of the Bank of America Institute on the state of consumer spending. We begin this hour with our top story, a second day of trade talks in London.
We are doing well with China. China's not easy. We want to open up China. And if we don't open up China, maybe we won't do anything. But we want to open up China. It'll be a great thing for China, a great thing for the rest of the world.
On the ground over the last couple of days, Bloomberg's Annmarie out of London. Annmarie, day one, and we were told it was fruitful. Talks are going well. What are we looking for from day two?
Well, we're looking for day two then to come out with some sort of agreement and for acknowledgement that each side potentially is going to really get back to what they agreed upon, Jonathan, 4 weeks ago in Geneva, because Washington and Beijing basically accusing each other of reneging of what they agreed upon on those talks in Switzerland. Day two of the meeting, I will say they're just a little bit over an hour sitting down, the Chinese delegation and the U.S. delegation, after more than 6 hours at the table yesterday. I should note, I don't know if this is a barometer, but food delivery was just brought in once again from the famed Israeli-British chef Otto Lengi, brought in for day two. Potentially, they are eating now and having these discussions. But we have to remember and remind our audience, this can only be the second and final day, at least, of the London talks, because Treasury Secretary Scott Bessent is on Capitol Hill tomorrow, and he's not going to miss his hearing before the House Ways and Means Committee. So they are really at the crunch time now. What we are expecting is potentially easing of some export controls, the more recent ones when it comes to the U.S. side. And then what they want to see out of Beijing is an advanced pace of getting their hands on the rare earths and magnets that Beijing basically has a complete control of, with 70% of the market that China has control over.
If Otto Lengi can't bring people together, I don't know what can, Annmarie. But if we get some sort of agreement coming through from here, do we understand what happens next? This is just on rare earth metals and tech exports and imports. What after this, Annmarie?
It's a great question because these are the two real choke points and red lines, especially for the United States. If they are willing to give in on some export controls, maybe some of the more recent parts, some nuclear material, some chemical materials, jet engine parts, what happens when China says we need more? We want to get access once again back to those NVIDIA chips that were made to be export compliant under the Biden administration, those H20 chips. And now you can see the complications of this dance. As Jonathan said earlier in the program, it's 2 steps forward, 1 step back. And yes, we are still just talking about two provisions of this deal, two policies of this deal. We're not even talking right now about the purchase agreement that Trump handled in his first administration, which we should remind our audience, that took 18 months. The trade war began in 2018, and we didn't get agreement till 2020.
It feels like we're working very hard just to stand still at the moment. Annmarie, with the latest in London, Arthur Wenger getting free promotion, hey? I mean, I like the food. It's fantastic.
It's really good.
I'm not sure who's driving that order out of the US delegation.
Yeah, you would think that they'd try to get something really American, maybe a McDonald's, throw something like that in there. Kind of interesting they're using a very British-Israeli type name to bring them food.
I'm going to say that's Secretary Besson, but we'll try and find out. Let's get you the view on Wall Street this morning. Joining us now is Matt Miskin of Manulife, Hancock Investments. Matt, welcome to the programme, sir. We won't talk about food. We'll talk about markets. Lisa Shannon of Morgan Stanley making the point that she believes this is a market looking for a credible narrative. Do you think there is one?
Earnings growth is the last bastion, the most important fundamental driver of stocks. In the U.S., earnings growth is there. We're seeing about 13, 14% earnings growth, but no one cares. Actually, U.S. quality stocks are the worst performers within the U.S. equity market and for the global market. Quality is on sale. The U.S. is on sale. The Sell America trade that we've seen for much of this year has made U.S. assets of the best value we're seeing per pound for the earnings growth you're getting. So earnings growth is the only thing that's going to get you there. In Europe, earnings are down on a year-over-year basis, about 4%. In small caps, they're down. In mid caps, they're about flat. U.S. large cap quality stocks have the best earnings. The only problem is the markets don't seem to be paying attention to it.
How is that possible when we're just 2.3% away from all-time highs and still trading at multiples that look like something like 22 times for the S&P 500? Matt, where's the bargain here?
Yeah, no, it's more that the rally has been sentiment driven and multiple expansion. And we're in the part of the cycle where we're now seeing companies issue debt and preferred stocks to buy Bitcoin. So there is a lot of multiple expansion out there. It's been a global multiple expansion story, but it's interesting that the earnings growth companies are ones that haven't done as well this year. So they're up about 1% in terms of the quality factor this year. We actually think on a relative basis, the risk reward looks the best within equities. And then frankly, we're looking at the bond market and we're seeing a lot of income. The old narrative that it's a low interest rate world, it actually does apply for much of the world except the United States. And so we're really gearing towards income producing assets, providing income for clients, and using a multi-asset portfolio to get as much return potential we can.
So are we going to look at something like 4.9 on the 30-year yield, Matt, and say that is the buy of a lifetime, despite all the volatility it's seen?
You know, the last couple of years in bonds have created a ton of value. We basically had a bond bear market that was similar to that of 2008 for stocks. And we see that the 30-year took it on the chin of the most. Around a 5% yield for the next 30 years, we don't think it's going to be the worst investment decision you can make, but there is a lot of volatility there. And so we're more geared toward the intermediate part of the curve. We're looking at about a 5 to 5.5% yield. And we're in higher quality parts of the bond market. Quality, again, in bonds is on sale on a relative basis because high yield spreads have tightened up again. And so when we look cross asset, we actually do see the longer end of the curve isn't the worst decision. We're more in the intermediate. And again, being patient, getting paid income, and watching a lot of these narratives play out in the narrative merry-go-round of global markets.
It feels like we've been on that merry-go-round for a number of years now, Matt. Lisa was here yesterday and she alluded to the following question. I think it's an important one. Typically, when everyone starts talking about bond auctions, and I mean everyone is talking about a 10-year and 30-year auction through the next 48 hours, usually we've reached an extreme. Usually things start to turn the other way. Do you think we're at that point going into the supply we get later this week?
Yeah, so we hit about 460 on the 10-year, and then we backed down. And it's around that 460, 480 levels that we've been more of a buyer and looking at opportunities there, and it has moved quickly. The whole narrative right now is focused on tariffs. No one is paying attention to the housing market, which is actually the biggest driver of inflation. It's 35% of the index. We're seeing housing slow dramatically in the United States. Supply is hitting the market in a significant way in California, Florida, Texas, and this is likely to weigh on housing. And if housing comes down, inflation comes down. If inflation comes down, the Fed is behind the curve. And we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs, which means they're not data dependent. That puts them behind the curve, and they're going to have to probably cut more than the market thinks in the back half because they've been waiting and waiting and waiting when they should be looking at the data.
Matt, put some numbers on that. When you say more than the market thinks, how much more? What kind of number of cuts are you looking for?
I think this year could be similar to last year, where it's back-end loaded, which is more hawkish relative to expectations, but then dovish in magnitude. So we think there could be 4 cuts at the back half. Right now, there's only about 2 priced in.
Matt Miskin of Manulife, John Hancock Investments. Matt, thank you, sir. Another 100 basis point of cuts later this year, according to Matt.
That's very far from where the market is. In fact, the market is under where the Fed's dot plot is. I think we only have one full rate price cut priced in, maybe about 77% odds that we would get to. But that's because the data has been better. Even the sentiment figures have started to be better, and the market has taken notice of that. So something would really have to turn to get it to 100.
Looking for CPI tomorrow morning. PPI after that. Yields a little bit lower this morning. We're down 3 basis points on a 10-year maturity, 4.4460. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The Trump administration has deployed 700 Marines to Los Angeles to respond to anti-deportation protests. The state of California is suing to try to stop the deployments. President Trump backed comments from border czar Tom Homan that California Governor Gavin Newsom could be arrested if he interferes with their response. Meanwhile, shares of TSMC rose in Taiwan trading. The main chip maker for Nvidia and Apple reported a 40% jump in revenue for May as companies stockpiled chips in response to mounting trade uncertainty. While sales beat analyst estimates, they did fall more than 8% from April. And Apple unveiled the most sweeping redesign in its history at its Worldwide Developers Conference. The design, called Liquid Glass, will unify user experience across all its devices, from iPhones to MacBooks. As part of its rebranding efforts, the company also confirmed that it will use years, not version numbers, to identify its software. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the US and China working out a deal.
We are doing well with China. China's not easy. China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason.
Up next on the program, we'll catch up with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Quiet start to the week so far. Muted gains yesterday, this morning, just about unchanged on the S&P 500. Likewise on the Nasdaq 100. Under surveillance this morning, the US and China working out a deal.
We are doing well with China. China's not easy.
Did you give your negotiators any sort of
limitations? We're going to see. Look, China has been ripping off the United States for many years. Nobody charged them 10 cents. No president had the courage to charge China for whatever reason. They didn't want to do it.
So here's the latest this morning. A second day of US-China trade talks continuing in London. On his way into Lancaster House, Commerce Secretary Howard Lutnick telling Anne-Marie he expects the talks to go on all day today after saying they were fruitful just yesterday. Bloomberg's Tyler Kendall is with us from the nation's capital. She's in Washington, D.C. Tyler, do we know exactly what happened yesterday and why this has gone into day 2?
Yeah, hey, John. Well, I actually was pretty struck by what Kate Kalutkiewicz, the former Trump trade official, said on this program earlier, which is that if the goal here is ultimately to get to restoring the agreement reached in Geneva, that should have happened relatively quickly. So perhaps that these talks have extended into a second day. That indicated to her that one of the sides here might be dragging its feet. Now, of course, we haven't really gotten any details on exactly which side or which of those issues could be the hang-up here, but we know that at the heart of these negotiations is that both countries have imposed restrictions on products that the other country relies on. And that really does come down to these export controls. Now, as you heard there, I tried to press President Trump yesterday at the White House if he gave his negotiators any sort of limitations when it comes to export controls, and he didn't rule it out. And our reporting does indicate that the U.S. has signaled a willingness, perhaps, to lift some of the recent restrictions put in place. But that would, of course, come in exchange for China pledging to give some sort of reassurances when it comes to speeding up the export licenses related to critical and rare earth minerals. The U.S. has signaled, people familiar tell us, that they would focus on those recent restrictions that have gone into place, such as on jet engines or the software used in chips. Now, of course, John, it probably goes without saying that these talks are, of course, incredibly high stakes here. It doesn't really seem like we would get some sort of lowering of tariffs at the end of these conversations in London, but it's probably a good reminder that Bloomberg Economics finds that the levies that are currently in place could cut U.S. imports from China by 70% over the medium term.
Well, Tyler, you mentioned some of the language coming out of U.S. officials. What have or haven't we heard from China, and what does that suggest on how likely they are to accommodate some of these demands from America?
Well, Danny, there definitely seems to be a more tempered tone here, and they have been pretty firm that they want to see the U.S. lift its restrictions. That's sort of the line that we repeatedly hear from Beijing when it does come to these talks. And there's been a lot of focus on the fact that Commerce Secretary Howard Lutnick is included in these talks, and perhaps that does signal a willingness to put these export controls on the table. But we also have to keep in mind that Howard Lutnick at times has indicated that he has a pretty hawkish stance when it does come to China, telling lawmakers last week that he wants to see a tighter enforcement when it comes to those export controls. And Danny, there's of course a lot of other sort of extra things on the table here that China has raised concerns about, including U.S. plans to revoke Chinese student visas. And even as we did hear President Trump last week say that Chinese students would be welcome here in the U.S., it really remains to be seen if they're going to fully roll back that policy and whether or not that would be enough for China to get on board with the broader deal.
Tyler Kendall with the latest down in Washington, D.C. Tyler, thank you. Joining us now to continue the conversation, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. So this was framed quite simply yesterday. Going into the room, we were told the US would push to drop some restrictions on their side in order to ease the limits on rare earth shipments from the Chinese side. Now, I guess we've got two options now. Either that's proving more difficult to do as we go into day two, or they're shooting for something much bigger than just that. Is there reason to believe it's one and maybe not the other?
Well, I'd like to offer a third alternative and connect a few dots here. I don't think we're talking about tariffs anymore. And I think that's something that the street is coming to understand right now, and China has already grasped, which is that when we got a CBO score suggesting that these tariffs that are in place today are generating $2.8 trillion in revenue, and the White House starts immediately putting out memos incorporating that threshold into their public presentations on the state of the tax bill and the reconciliation package, we're not negotiating for tariffs to come down. The tariffs that are in place today are very likely to continue across all nations, not just China, but Japan, South Korea, the EU. And they're going to also see sectoral tariffs on pharmaceuticals, semiconductors, trucking, aircraft in the months ahead. So what's being negotiated are the extraneous issues that, of course, since the Geneva meeting, both sides have ratcheted up, whether that's on limiting student access to the United States for Chinese students, or the Huawei chips, or AI, or rare earth magnets. They're expanding the scope of this war and no longer negotiating just the tariff rates. I think that they're looking for an excuse to get past Liberation Day, which in this case is in August, and come up with any reason to keep tariff rates where they are while they fight on different fronts.
Henrietta, can they use tariffs as a crutch then? Can they use the tariffs in the negotiation? Or are you suggesting that they are just completely to one side, they will remain, and that's not going to be touched for the foreseeable future?
I think they can go up. I don't think that they're going to come much further down. 30%, as we all recall, is obviously way lower than the president initially wanted. He gave Bessent the go-ahead to drop rates down to 80. We know that anything above 50% is effectively an embargo on trade. And 30%, cargo is just now starting to get back to where it was before April 2nd or before Trump took office. I don't think they're going to go much lower than 30%. Again, that revenue score of 2.8 trillion is just too attractive. So the threat is permanently there of tariffs rising, and I believe they will on a sector basis. And I was speaking with another former USTR recently, and he suggested that one or two nations could be made an example of, Nicaragua, for example. But for the most part, these tariffs are here. They're here to stay, and we're going to have to fight on other fronts.
What does that say about negotiations with other countries, Henrietta? When the 90-day pause comes due in July, is it your expectation that we also get a resumption of higher levels of tariffs, something like we saw on Liberation Day?
I don't think so for most nations. I think that the administration is looking for an excuse to extend the July 9th date out into the future. I don't have a good sense of how long they want to extend it out into, 30, 60, 90 days. But one thing that I really can't square is that the Liberation Day of 2.0, July 9th, is well before when I anticipate the tax bill passing. So you have this awkward dance between Republican lawmakers trying to pass this bill on the Hill and the July 4th, 4th of July rally that the president is hoping to have, and then the July 9th expiration date. So I think the dates are a little bit fuzzy, and they don't really quite have a streamlined narrative. The tariffs and the tax bill haven't quite blended perfectly, and I wonder whether that might come into the conversation.
There's one more piece of the puzzle at the moment. As you know, the White House increasingly distracted by what's happening on the West Coast in Los Angeles. Henrietta, do you take the point, maybe make the argument that they're much more comfortable with that story developing in Los Angeles, and maybe that takes some heat off the passage of the bill, the tax bill in Washington?
Oh, yeah, they got to love it. And the timing is perfect. Tomorrow or Thursday, the Judiciary Committee is putting out their $175 billion package that is going to spend money on immigration. And one of the things that has been lost in the last week of Elon Musk and Donald Trump feuding over Twitter is that the whole package, the reason we're doing one big beautiful bill instead of two, is because there's a tremendous amount of dessert in this bill. There's $350 billion in funding for the military and immigration, and that's what's going to carry this bill over the finish line. I've only seen one senator come out against those spending levels, and that's Rand Paul. And even he wants some level of spending at $75 billion. He just doesn't think we need the full $175 billion. So I 100% expect for this immigration conversation, the raids in LA, sending in the National Guard, advances my odds that the OBBB gets signed into law.
When all is said and done, how different will that bill look to what was passed in the House?
It's going to be substantially more deficit increasing. I'd say at least $400 billion more in deficits. The SALT cap is not going to be as generous. The IRA tax credits cannot be cut back as much as they have been. This is just a tremendous job growth in key states that need it, including Alaska and North Carolina, where there's at-risk Republican members. It's going to change quite a bit.
Henrietta Treyz of Veda Partners. Henrietta, thank you. Something to mull over, think about going into those debt auctions tomorrow, 10-year, day after, 30-year.
Yeah, but all the bears keep looking to the debt auctions and say, it's going to be bad, it's going to pull back. We haven't really seen that. The auctions since Liberation Day, they've been fine. Maybe you can't say the same for Japan, let's say.
Apart from the 20. I'm not sure what.
Yeah, but the 20's
I'm not
never
sure
loved.
what a 20-year auction says about anything anyway. I agree.
I don't think we can take much signal from that. The auctions have been fine, but there are plenty of reasons to be worried. The one big beautiful bill is getting passed. And just another thing to throw in there, Paul Donovan saying that the images in LA are worse than it actually is on the ground. And the foreign investor community will look at that and say that there's more dysfunction in U.S. and maybe just add that to their list of why they want to flee American assets.
I asked Lisa yesterday whether we should kill the 20-year maturity, and she said put a stake through it.
Wow, Lisa wants one less auction?
One less auction,
Surprising.
one less maturity.
It's very surprising. I think that's the signal right there of how bad the 20-year auction is.
Couldn't agree with you more. Up next on the programme, David Tinsley of the Bank of America Institute on the state of consumer spending. We saw a lot of front-loading. Are we getting the bill for that through this summer? That conversation up next, live from New York. You're watching Bloomberg TV. 2 days of gains on the S&P 500. Pretty muted stuff to kick off the trading week. Unchanged so far this morning. Off the low of April, though, higher by 20.5%, and now just 2.25% away from all-time highs on the S&P. This morning, unchanged. If we switch at the board and get to the bond market, BMO's Ian Lincoln this morning saying this: the looming gauntlet of duration. 10-year yields are lower. 30-year bond yields are lower. Going into tomorrow, $39 billion of 10-year notes. The day after, $22 billion of 30-year bonds. That's the next step for this debt market. 2 hours away from the cash open. Let's get back to equities and get you some morning movers with Yahira. Hey, Yahira.
Hi, John. As you mentioned, it is a pretty muted morning, but I did happen to find you some movers. We start with Tesla. Those shares are up 2% in the pre-market after rising 4.5% yesterday, defying 2 downgrades from analysts, including Ben Kallo, who will be on our program later this morning. And this, of course, comes as the EV maker tensions seemingly ease between Elon Musk and President Trump, and as Tesla and as buzz built around its robo-taxi launch event anticipated this Thursday. Meanwhile, next up we have shares of Novo Nordisk. Those are up 3.2% here on an FT report that activist hedge fund Paribas Asset Management is building a stake in the Ozempic maker. And they report that Paribas wants to say in who will run the company next as it faces rising pressures in the booming weight loss drug market. But not booming has been this stock, which has been cut in half in the past year. And last up, we end with Meta rising 0.7%. And this is as we here at Bloomberg report that CEO Mark Zuckerberg is frustrated with its latest chatbot models. And because of this, he is personally building a secret super intelligence team and even holding recruiting dinners at his homes as he tries to assemble the best of the best to achieve artificial general intelligence. So investors hoping that may lead to some real progress. John?
Yahira, thank you. More from Yahira in just a moment. Just want to get you up to speed on some news. Steve Schwarzman of Blackstone sitting down with Bloomberg just moments ago, planning to invest $500 billion in Europe over the next decade. That's pretty punchy stuff, mentioning that Blackstone has lots of money to put to work. Also, a few takes as well on tariffs resolving themselves in, say, 9 months' time and not seeing a great impact on the inflation side.
Yeah, on the short end of things, he thinks it could happen in 6 months, which is really optimistic considering last time around it took 18 months. But that is the kind of thing that moves investors like Blackstone to Europe. We heard from Apollo last week at the conference I was at, Jim Zelter saying that they would invest $100 billion in Germany, just in Germany. So as tariffs take hold, these executives are paying attention to it and are shifting more of their resources to Europe.
That's the latest from Blackstone. We'll try and bring you some of that conversation a little bit later this hour. On our radar this morning, our top story, a second day of US-China trade talks kicking off in London. Both delegations looking to ease tensions over rare earth exports and technology shipments. President Trump saying just yesterday, quote, "We are doing well with China. China's not easy."
He says they're doing well. Secretary Howard Lutnick, Commerce Secretary, told Annmarie that they were doing well this morning. Bessent called it a good meeting yesterday. But what you're not hearing is the Chinese delegation giving comments. You're not hearing much from them saying things are going well. What you are hearing, for example, a strategically and very well-timed placement from the Huawei founder saying that U.S. technology is not that important to us. We have workarounds from things that we would get restricted from the U.S. So it seems like the narrative that China's at least trying to build is we have the upper hand, we can wait this out, and you can't.
Henrietta Treyz of Veda Partners said something else we're not hearing at the moment. I think it's a really important point that we have to underline. We're not hearing about removing tariffs. We're not hearing about taking down tariffs. It doesn't even feel like that's part of the conversation over in London today.
No, it's really not. It's put to one side, and her assumption is that tariffs stay at the higher level. But what you're getting from these negotiations is an administration that's able to move beyond Liberation Day, that can talk about something besides it. But what does that mean for business? Okay, you get an agreement on rare earth metals, that's good for the autos. But what happens if we still have tariffs that look like something like 30%, if that doesn't budge?
That's the latest on trade. We'll have more on that story with Annmarie, who's in London. She'll be joining us in the next hour. I want to get you an update on the latest in tech. Mark Zuckerberg is prioritising recruitment for a so-called AI superintelligence team. Sources telling us here at Bloomberg he's frustrated with AI shortfalls and thinks Meta should be outstripping competitors on artificial general intelligence.
First of all, I love that he's holding dinners and trying to recruit people. Mark Zuckerberg, I'm not an engineer, but I will happily come over for dinner. But it does just underscore that there's this real risk and falling behind. I mean, something as ubiquitous, for example, as Google search gets completely upended by ChatGPT. And that is the risk for Meta. Even though they're already spending lots of money on AI, if they don't do something in artificial general intelligence, which is kind of the next leg up, does that mean that they will have spent billions for nothing? That they spend billions and someone else comes in and completely disrupts them? So they need to spend what is an ungodly amount of money, it seems like, trying to form a moat to make sure that doesn't happen.
Reminds me of the Facebook days. Do you remember when they left the desktop behind and became mobile first, and he basically told everyone around him he doesn't want to hear anything about improvements to the desktop experience. He wanted to be mobile. Feels like it's that this time, but with AI.
Yeah, it does feel like that. He's trying to move on. Of course, I wonder what the corollary is of our parents still using desktop Facebook and I don't know, of that kind of
People still use desktop Facebook?
I think there is a generation that still logs on, my mother being one of them. Logs
Really?
on. Yeah, she logs on to her Facebook on her desktop and, gives a thumbs up. And I don't know, do people still do pokes on Facebook? I don't know what she does on there.
I'm not throwing shade at Mrs. Berger. Good morning to you. Let's turn to the latest on Apple. Failing to impress investors at its Worldwide Developers Conference, the company announcing it will roll out new software and features like live translation. It is yet to strike any major AI deals and says it still needs more time to bolster some AI elements.
It feels like it is Apple trying to learn of the missteps of their last Worldwide Developers Conference. Because you'll remember they came out pretty punchy with what they saw happening in AI. They talked about Siri, that Siri would be advancing. What happens when you get the open of this Worldwide Developers Conference? It is a delay to Siri. So perhaps it is just a more conservative Apple that has fallen behind and doesn't want to promise anything. Instead is just giving us all these flashy liquid glass or whatever it's called.
And emojis.
And your favorite, the Genmojis, yes.
Yeah, or not. That stock is down again this morning by 0.2% on the year. Year to date, we're down by close to 20%. For shares of Apple. Let's turn to the US consumer. Bank of America releasing its monthly consumer checkpoint report with a read on how tariffs impacted spending in the month of May. Joining us now is David Tinsley of Bank of America Institute. David, welcome back to the programme. So you know how much I enjoy an update on this story. So let's start here. We understood that there was a front loading of purchases from consumers ahead of tariffs and after we saw those big announcements. Are we starting to pay the price for that? Are you seeing any sign of that whatsoever in your latest research?
Yeah, thanks for having me back. Yeah, very much so, I think. So in our latest data for May, the card data fell 0.7%. And there are kind of three reasons for that. But up front, in a sense, is that payback. So we saw electronic spending ramp March, April. It fall back to a negative year-on-year growth rate in May. There are some other reasons for that weakness in May, that relatively soft print in May. One was the weather, it was a bit cold and wet essentially around Memorial Day. And there was also just a broader kind of slowdown across the US regions as well. So I think those are the kind of mitigating factors, I think I would say. The underlying spending growth is probably stronger, and you can see that in the labour market data, I think.
David, I always think these updates are a good opportunity to do the maybe quarterly panic of should we be worried about buy now, pay later? You talked about the fact that millennials and Gen Zs are spending more than their Gen X counterparts. Is there a reason to be worried if that is starting to pick up, especially among a younger cohort, which tends to have more credit issues than, let's say, the older?
Well, it's pretty interesting. So in this report, we pull apart the differences across the generations, and we see that older generation spending growth is still pretty solid, while younger generations, I'm thinking Gen Z and millennials, spending growth around about zero. Why is that? It's because they've got all these other pressures on them that don't show up on card spending. Student loans, housing costs, childcare costs. Those are all eating into their reasonably strong wage growth. And two pressure points we point out in the report are credit card utilisation is rising somewhat for millennials. It's a little bit above 2019 levels. Good news is it has flattened off that rise over the last year or so. And buy now, pay later, as you're discussing, that is showing a trend rise. I mean, I would qualify that by saying only around 10% of millennials and Gen Z are making those payments in the latest month. So it's by no means a pervasive thing, but that is rising.
So if we continue to have that rise, if there are little pockets of weakness, David, how important is it that we get some resolution in the tariff discussion, how much of the consumer spending we're seeing, of credit card utilization, of willingness to make big purchases really hinges on outcomes we're getting from Washington, D.C.?
Well, I mean, I think it does help, but I would call out, and we discussed this a little bit in a report today, you know, the swings in economic uncertainty and consumer confidence often have a surprisingly weak connection with what consumers actually do in our data and also the broader macro data. I'm not saying it isn't important, it is important, but I think consumers, all the time there's jobs growth, all the time there's wage gains, they will keep spending. So I think, you know, the weakness, if it came from that tariff story, that trade story, would come via corporates, slowing jobs growth, and then on to the consumer.
Let's talk about it relative to incomes then, David, because you're touching on something important. Are income levels holding up? Do you see that in the data you're looking at?
Well, you know, it's quite interesting. So we had this good jobs growth last Friday, didn't we? And in our data, we were quite pleased. We were always quite pleased to see when our data stacks up, you know, closely with other reads. And in our data, we actually did see after-tax wages and salaries rising, the growth of that rising across all income cohorts. Now, it's strongest for the younger generations, as I was discussing earlier, and weaker for the older generations. And when you look at it by income, it's been softer over the last, say, 6 months for lower income households, but the pickup was across the board. So, and I think when you see that against what we saw, I think, on JOLTS, on the payrolls, it doesn't seem a situation in which the labour market is by any means weak enough for the consumer to really rein their spending in at the moment.
David, just to jump on this and just take you away from the latest report, as an economist, when you start to think about second round of effects coming off the back of the tariff story, do you think that maybe there is some fertile ground left here for inflation to bubble up?
Well, that's a good question. I mean, consumer spending is not, in an underlying sense, notwithstanding that drop we saw in May, soft, we don't think. So in some sense, consumers still are giving the economy the room for some pass-through, I guess, from cost pressures into CPI. So I don't make these inflation forecasts, thankfully. But I do think, you know, we're not necessarily in a weak enough for a disinflation kind of environment to take hold. Still very much a stagflation story, I think.
Interesting. David, thank you, sir. Appreciate the update, as always. David Tinsley there of the Bank of America Institute. I think we've all been super frustrated with the image survey. And increasingly that looks like a political poll and not an economic survey at all. Income levels will tell you a lot about whether people are willing to spend or not. And that's ultimately where David took that conversation.
Which, by the way, the New York Fed Consumer Sentiment Survey we got yesterday is another great reason to maybe, I don't know, completely ignore you, Mitch. Not only did we get a rebound in expectations for inflation, labor market statistics, labor market surveys were also really, really strong, too. So maybe you can just say it's noisy, all the data is noisy, the way people feel, it's really volatile. Maybe that's a problem within itself. But it's a reason not to put too much importance on some of these.
I definitely want to see more of that, that's for sure. Equity futures at the moment, by the way, if you're just tuning in, just about unchanged on the S&P, with an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. Ukraine says Russia attacked it with drones and missiles early this morning in Kyiv. This comes after the two sides started a major prisoner exchange. The first groups of prisoners under the age of 25 were transferred. The planned swap of 1,200 people from each side is set to be the largest to date since the invasion of Ukraine. Meanwhile, Huawei founder Ren Zhengfei is not concerned about U.S. export restrictions on China. The prominent business figure telling the Chinese Communist Party's official newspaper he is confident China can make breakthroughs in AI and software, but notes Huawei is, quote, lagging one generation behind the U.S. And in sports, the Florida Panthers had a commanding win in Game 3 of the Stanley Cup Final, beating Edmonton 6-1 on home ice. Panthers center Sam Bennett scored his league-leading 14th goal of the playoffs. The Oilers took 21 penalties, totaling 85 minutes in the box. The win gives Florida a 2-1 lead in the series ahead of Game 4 on Thursday night. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next, a test for the Treasury market.
Treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself.
In just a moment, we'll catch up with Tony Rodriguez of Nuveen on the bond market and get you the latest, an update on the trade talks in London between the US and China. Tuesday morning, good morning to you all. Equity futures at the moment just about positive by almost 0.1% on the S&P, likewise on the Nasdaq. Under surveillance this morning, a test for the Treasury market.
Treasuries have not lost their edge as a hedge against the state of the world in which growth decelerates. And so yields will go lower as sort of growth slows down. And I think from a multi-asset standpoint, you still want to keep a little bit of exposure to duration to protect yourself.
So here's the latest this morning. $119 billion in Treasury notes up for auction this week as traders look to gauge appetite for US debt. Tony Rodriguez of Nuveen writing long duration is attractive as a hedge for equities and broader risk assets. Tony joins us now for more. Tony, good morning.
Good morning, Jonathan. Good
Do you think that more comfortable correlation does return then? Are you seeing signs of that?
We are seeing signs of that. You've seen that in some of the little hiccups we've had in the equity market. And when you think about why that's taking place, is that we finally have a yield level that's reasonably attractive. And you also have markets that we would argue are fully valued. Whether you look at the equity market, whether you look at risk assets, it's hard to argue anything's super cheap. So right now, when you're looking at the economy slowing down, rates being high, an investor that's looking for income and a hedge, we think you'll see that rally in treasuries because we think that will really reduce any inflationary pressure that comes into the economy through wage pressures. And therefore, rates can fall in a really negative outcome, which is not our base case.
Sure.
But in that tail risk, we think it will serve as a good hedge.
That's the risk aversion test for the Treasury. Let's talk about the supply test for the Treasury market this week. 450, close to that on 10s, close to 5% on 30s. Sufficient levels to bring in that demand when we get those auctions this week?
Yeah, we don't think they're cheap enough to bring in excess demand, so you're not going to get the strongest auction statistics you've ever seen, but we think we're at fair value. So we're not expecting to see a failed auction this time, and we haven't really seen that, right? So bid to cover ratios have been okay. The tails have been average. We're expecting a similar story, but everybody's on alert for that first auction that actually, shows a really negative, soft outcome.
It seems like we've been on alert for a while, Tony, and it has yet to happen. Where it has happened is abroad. You saw weak auctions in Japan, and that was enough to move around the U.S. Treasury market. How fragile and how exposed are we still to international results from auctions and just more generally higher bond yields across the ocean?
Yeah, they're very correlated markets. We've seen term premium rise across multiple global markets, right? We've seen yields rising. So very integrated. So we are sensitive to that. But the good news is that you've seen policymakers also respond to that. So the Bank of Japan responded to that. So their quantitative tightening, they might slow that down. We saw the U.S. Treasury Secretary say that they may consider adjusting some of their supply, expectations over the coming months. So policymakers are responding to the potential for soft demand and longer duration assets, and that's supportive.
Is that not a problem, though, that policymakers have to respond? Tony, this is usually the thing you see in emerging markets, that there's not enough demand for longer-term debt, so you get changes or you get inability to actually issue longer-term debt. Is the very actions within themselves, the fact that they have to do it, a problem?
Yeah, we don't think it's a problem, but we do think it's reflective of the fact that the fiscal pressures that we are seeing globally, but dominated really by the U.S. right now in terms of 6 to 7% deficits, those are going to be something that has to be reckoned with. It's just that unlike in emerging market countries where that debt balloon pops and you get an immediate crisis, the debt balloon in a country like the U.S. is more like Japan in the 90s, where the air comes out slowly. So the U.S. is not going to, in our minds, have some sort of immediate sharp crisis, but it will have this kind of slower weakening that takes place from elevated rates that are a weight on growth, that take away some of the supply and ability for companies to finance as attractively. And so that just places a dampener on growth broadly. So it's a slower kind of pain than necessarily a sharp disruption.
You said risk assets were fully valued. Does that include credit and high yield?
Yeah, we think it's fully valued in terms of reflecting what are strong fundamentals. So we're not expecting a lot of price performance from tightening spreads, right? We think the carry, the yield, is pretty attractive. You can kind of earn that 7.5% type of return, which is comparable to equities with a lot less risk. And it's reflective of solid balance sheets, good cash flow, right? Defaults that are going to rise, but not very much. Where we're a little hesitant because spreads are only fair is to go down in the deepest end of the pool. So CCC credit risk might do great if the economy really performs well, but that risk reward is not as attractive as sitting in double B credit, higher single B credit, where again, fair compensates you for good fundamentals and strong technical conditions.
You could fool yourself into thinking, though, that there's no concern with the junkiest of credit, just given the issuance we've seen. I think for May was the strongest amount of junk bond issuance since October. There's demand there, and there's also taking advantage of a lull. But is it a false sense of calm? Are we tricking ourselves into believing that it is calmness, especially for the more risky edges of the market, especially headed into July where tariff deadlines come due?
Yeah, well, you bring up a good point. So a lot of companies typically they fail because of lack of liquidity than necessarily business fundamentals they can't work through. So that liquidity is very important. The high yield market had been kind of having below normal supply, and now that's kind of accelerated a bit, but it hasn't gone to an excess level in our minds. It's just gotten back to a normal supply-demand relationship. We think that's healthy. We think that liquidity is going to remain in place. So that's part of why we think the default story, while we'll see an increase, it's not going to be a sharp rise unless you get a really negative kind of exogenous shock, which could come from tariffs, could come from geopolitical. Absent that, the underlying fundamentals for cash flow and the liquidity conditions are pretty supportive of kind of remaining at these fair value levels.
Tony, I've known you for a long time. Just listening to you here, it feels as if April never happened. And looking at where markets are priced at the moment, it looks like April never happened. Has anything changed for you, fundamentally?
Yeah, well, yes. What has happened is that the kind of fragility that exists is greater today. So we thought we'd be growing at 2% coming into this year without the April news. Then you could kind of absorb a punch, whether it was oil prices, geopolitical. Now we're thinking 1% growth. So that at 1%, any shock, a disruption to a auction, for example, that can now push you into recession. So that tail risk has increased for us. So recession risk, 20% coming into the year, 35% now. Still not base case, but enough to say what gets tipped over into default in that environment, it's those CCC weaker credits. So if they survive, we avoid recession, they're going to do fine. But if we have that little hiccup, that's where you want to be a little bit better, higher in quality, a little higher in liquidity to give you room to be able to adjust to those weaker conditions.
Got it. Tony, appreciate it as always. Tony Rodriguez there of Nuveen on fixed income. Could be interesting this week. CPI, PPI, 10-year debt auction, 30-year auction as well. Up next, we'll catch up with Mike Wilson of Morgan Stanley, Ben Kallo of Baird, Matt Luzzetti of Deutsche Bank, and Terry Wizman of Macquarie. Mike Wilson has 3 words for you. Don't fight it. That conversation up next.
Right now, we're witnessing a fundamental repricing.
The market has got, to some extent, I would say, desensitized to the daily gyrations in the numbers.
The markets have been very tolerant to a lack of concrete tariff progress.
Tariffs at this point in time, I think, are just overstated. The fear is more important than the fact.
Ultimately, we will break to new highs.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening bell. And so far, pretty quiet. Equity futures positive by about 0.1% on the S&P 500, following back-to-back gains. It's day 2 of trade talks between the US and China. We'll catch up with Annmarie in just a moment. Annmarie reporting just moments ago they're on a lunch break until 2 p.m. London time. So for the next 60 minutes or so.
They're on a lunch break, which is good news because we don't want to see anyone walking out for maybe any other reason besides food. You do get the sense, and John, I feel like we're hearing this more and more from people who are around this table, that the trade talks aren't the most important thing, is that it's earnings. There seems to be headline fatigue, real headline fatigue of trying to trade on each individual thing that comes out of this time around London. And maybe you just need to focus on the company fundamentals, and earnings season wasn't that bad.
The earnings have been okay. The data's been decent too. Held up. I'll put it that way. If payrolls was bad on Friday, and some people think it was bad beneath the surface, I think we'd be having a very different conversation this week, and we mentioned that yesterday.
Yeah, Neil Dutta been very clear that underneath the surface that the labor market has not been holding up, that things like cyclical industries are starting to suffer. But even if the market data was bad, John, I wonder how much that would just cause a temporary blip, because there is this belief that you can't trust the data either, that you're seeing pull forward effects, that sentiment is biased by politics and is uneven. There seems to be this real sense that you're not going to get any sort of clarity until much later this year.
More data this week, never mind this year. CPI, PPI coming up Wednesday, Thursday, and we've talked extensively about the debt issues still to come too. The trade talks continue in London. We'll catch up with Annmarie in just a moment. Through this hour, we'll be catching up with Mike Wilson of Morgan Stanley as stocks look for a third day of gains. Ben Kallo of Baird on his downgrade of Tesla to kick off the trading week. And Matt Luzzetti of Deutsche Bank looking ahead to that US CPI print. We begin this hour with our top story. Trade officials from the US and China meeting in London for a second day of talks. Annmarie joins us now with the latest. Annmarie, what's the latest?
Well, Jonathan, there's no breakthrough, but we do know there is a break for lunch. We did see the Chinese vice premier who's leading the Chinese delegation, He Lifeng, leave Lancaster House. There is a break for lunch, and they'll be commencing again at 2 p.m. local. But you can see the talks really feel like they're coming down to a wire. Not only did the talks last more than 6 hours yesterday, but then they had to bleed into a second day. And we do know that Treasury Secretary Scott Bessent has to get back to Washington, D.C. He is set to appear on Capitol Hill tomorrow in front of the House Ways and Means Committee, and then the following day in front of the Senate. So he has these two hearings that he needs to get back for. So it does feel like the talks are coming down to the wire. What we do know potentially that we could see from these talks is basically what we saw in Geneva. Potentially the United States are going to get quicker, more accelerated licensing of rare earths and magnets, and for the Chinese side, potentially the most recent export controls that we saw since the Geneva talks could be lifted.
Reluctant to make too much of it. Don't want to introduce any drama where maybe it's not required. But Annmarie, we should talk about this. These things take time to discuss. But ultimately, the White House themselves made this all sound very straightforward. Listening to the National Economic Council Director Kevin Hassett just yesterday, he said this could get wrapped up pretty quickly. So there's a range of different outcomes here. Either what they thought was easy is turning out to be harder, or they're shooting for something much bigger.
That's right. And at the moment, we actually don't know. There hasn't been a ton of dialogue with the individuals that are actually inside the room. Yesterday, when Secretary Bessent did leave Lancaster House, he gave a thumbs up and said it was a good meeting. Howard Lutnick, the Commerce Secretary, who's an addition from the Geneva talks, an addition official at these talks, which makes you think export controls are really on the table and important for the Chinese delegation to have that discussion. He said they were fruitful. And then on the way in, live on Bloomberg TV, he said to us that they talked all day yesterday. They're going to talk again today, and they're spending a lot of time together. Just because they're spending a lot of time together doesn't mean we're going to get to the end negotiation. Potentially, China is viewing this moment as leverage, maybe, knowing that the Treasury Secretary has to get back to Washington, D.C. The president told Tyler Kendall yesterday in the White House that China can be very difficult to deal with. Really, what comes to mind for me is what is the U.S. red line? If they're willing to lift the most recent export controls, we're talking about software for some chips, some nuclear and chemical materials, jet engine parts. But what China really wants to get their hands on is being able to get advanced semiconductors, those NVIDIA H20 chips. Is that potentially the red line that they are negotiating right now? Remains to be seen, but what we do know is that talks will continue at 2 p.m., and they just had a short break for lunch. But the Treasury Secretary, for him, the clock is ticking. He's on a stopwatch.
Annmarie, stay close. We'll catch up with you later in the hour with those talks set to reconvene, commence again in about 55 minutes' time. Here's the view on Wall Street at the moment. Mike Wilson Watson of Morgan Stanley taking a very constructive view on things, writing, the rate of change has turned for the better on most fronts. This keeps us positive on US equities on a 12-month basis. We expect pullbacks to be shallow and unsatisfying to those looking for a fatter pitch. Mike joins us now for more. Mike, good morning.
Good morning, John.
I love the recent note, don't fight it. So let's talk about don't fight what? What elements of the market move shouldn't we fight?
Well, it's kind of what we're just talking about. I mean, the headlines remain very noisy and uncertain, and I think, this has been the case for the whole year. Our view, as you know, has been a bit different. We came in thinking the first half would be tougher, and the rate of change on a lot of things like earnings revisions and some of the headline would be negative. And in fact, that what we think happens, that all got priced in the week after Liberation Day, right? It was violent. It was a deleveraging. And so now, as we look at the data itself, it's all inflected higher. And so, don't ignore everything, but ignoring the headlines is probably a good strategy, and just focus on the data has turned up for the most part. And I think, I don't know where the trade negotiations are going. Nobody does. Sure. But I think it's very unlikely we're going to go back to where we were, a month and a half ago. Like, we bottomed in terms of the pain of that initial, announcement and how bad those tariffs were. So unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now. You know what the bear view sounds like? They would say that maybe some of the data, some of the earnings we've seen have been flattered by pull forward, and we'll get the bill for that later this summer. Do you think we're priced for that kind of slowdown, that weakness we could see in the summer months? That's probably right, and we had that view too. There was a pull forward in Q1. Q1 ended up being better than they feared because, the numbers came down a bunch. I think the second quarter, though, is expected now to be weaker. So that's going to be the key. I think the biggest risk for the market is going to probably be either rates, as we've talked about in the past, north of 4.5%, or we do go in earnings season. It's not as good as, people were hoping for, and we have maybe a 5 to 7% correction. But that's not what people kind of want. People want another 10 to 15% drawdown to get, to get more exposure. And I just don't think you're going to get that. I mean, I've seen this a million times. You want it, but you're just going to have a shorter trigger finger.
Well, you had seen retail largely buying the dip. That's who participated when you got those ruptures in April. If we're not going to get dips like that anymore, what is the willingness of institutions to continue to put money to work right now, especially they didn't even buy the past dips we saw? Yeah, I think institutions have re-risked, but there's still more to go. The area that I think that you have to watch is the systematic strategies, the CTAs, that price momentum money. We saw almost $500 billion of deleveraging in that period of sort of early March through mid-April. And they've re-risked maybe 30, 40% of that. So that's another bid that's sort of, it's not fundamentally driven. It's just price momentum. So that's going to be kind of the underlying bid. And then I think, most institutions have re-risked. But one thing I haven't talked about yet is people are still making the quality bet. And we agree with that, meaning this isn't the beginning of a new cycle. It's once again an extension of the existing cycle. And the Fed's probably going to be cutting at some point later this year, early next year, and that really behooves the large cap quality equities. Does it behoove companies specifically who can also wait out some of the tariff uncertainty? Because this has been a big part of the narrative, right? No one's making decisions. CapEx is largely stalled unless you're tech. Is there an element where even though we don't have tariffs resolved, that you get companies who just get on with it and start to put capital to work? Yeah, they got to run a business. And that's another reason why large cap quality businesses can do this. They can mitigate some of these, risks, whether it's tariffs, whether it's, maybe the government cutting back on certain types of spending. And one of the things that is getting through this tax bill that I think is still underappreciated is the tax incentives for CapEx and R&D spending. We think that could add 3 to 5% to earnings growth or cash earnings for these large multinationals. That's a big tailwind in addition to the weaker dollar. So there's just a lot of tailwinds I see from an earnings standpoint. And this is almost a perfect environment to climb the wall of worry because the economic data, the political, geopolitical data is messy, it's noisy, it's scary sometimes. But as long as the revision factors for earnings are heading north, it's just hard for stocks to go down. When you say CapEx, I just think of a handful of tech companies. Do you think it goes beyond just tech leadership? Oh, absolutely. I think this is about capital goods. I think this is not just about AI CapEx. Also, one thing to just keep in mind, the IT CapEx that's been good the last several years has really been concentrated just in AI. Okay, the traditional kind of upgrades you see in the enterprise and in the household have not been happening because there was a giant pull forward, remember, in 2020 and 2021 for work from home. So if you actually look at the IT CapEx cycle from 22 to 24, it was kind of a soft recession.
And that's another part of our thesis. We've been going through these rolling recessions. And look, to me, the big catalyst to keep in mind for a broadening out is going to be when the Fed starts to signal they're more dovish. I don't know when that's going to be, but my guess is sometime in the third quarter they're going to start to signal that. And that's when you're going to get a more broadening out to the lower quality parts of the market.
Does the why matter? Do we need it because inflation is coming in? Or is it going to be because the labour market is cracking?
Well, I mean, look, last fall it was both, right? I mean, the labour market was cracking last summer. As soon as they signaled they were ready to step in, the market went up anyway. So that's why, I mean, I actually think a recession, if we finally get the, broad recession labor cycle, I don't think the equity markets are going anywhere near the April lows because the Fed will be able to act quickly. And we're like Pavlovian, right? And if retail is buying when the Fed wasn't even cutting, if they are cutting, there's going to be a big bid there. So, look, there's always risks in the market. There's always something to be worried about. There's always things to be bearish on, and there's things to be bullish on. And that's our job. And I think, this year we've navigated that pretty well, being in the right places. And I think we're going to continue to have to shift what we want to own, not so much how much you want to own.
You've acknowledged the one thing that could be a headwind for equities is interest rates. You wrote about it over the weekend. What is it about 450 that's challenging to this equity market? Because based on the rally we've seen over the past few weeks, we don't see much of a challenge.
Well, it's stabilized at 450. So we've identified this level like almost 2 years ago, and it's been like a charm. I mean, as soon as you cross 450 on the upside, the correlation between stocks and rates goes negative, and vice versa. Now, I do think that we kind of went to 470 in the April period, and then they calmed down again. I think the market is getting comfortable that they have enough tools, because the Treasury Secretary has talked about that, to keep it 450 or below if they need to. And I think we talked about this last time I was here. 475 is like the worst place, because that's where markets get really nervous. 5%, I actually get bullish, because then I know that they're going to come in and intervene with either liquidity injections or they're going to use these other tools that the Treasury Secretary has talked about. So we're optimistic that that could be managed. And in other words, that risk could be a risk for 5 or 7%, but ultimately that risk will get managed too.
Do you get clients asking you now about the debt auctions? Asking the equity strategist about the debt auctions that take place in the week?
Well, I don't really ask the equity folks, but I mean, people do ask about it for sure. I mean, and once again, we have seen many auctions, soft auctions for the last 2 or 3 years. We've seen this occur, and then they get control of it again. I don't want to dismiss the risk from the back end of the market. That is still, to me, the risk. I mean, it's the risk not only for markets, it's a risk for the U.S. Like we have too much debt, and this is a focus. And if we don't, ultimately, if we don't, cut the budget over time, and maybe the market is now giving them a lead, like, okay, we'll give you 12 months, But if we don't get serious about, budget reconciliation and actually reducing the size of the budget over time, this is an issue that's going to stay with us.
Mike Wilson of Morgan Stanley, 3 words over the weekend. Don't fight it. Don't fight this market. Mike, thank you, sir. Appreciate it. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the latest out of Los Angeles. The Trump administration has deployed 700 Marines there to respond to protests around immigration raids. Meanwhile, the state of California is suing to try to stop the deployments with the National Guard already there. President Trump backed comments from border czar Tom Homan that California Governor Gavin Newsom could be arrested if he interferes with the response. Meanwhile, Blackstone is planning to invest as much as $500 billion in Europe over the next decade. In an interview with Bloomberg, CEO Steve Schwarzman said he sees the region as, quote, a major opportunity. His comments are the latest sign of more investment firms turning to Europe. And this is an interesting one. China has invited American social media influencers to join a 10-day, all-expenses-paid trip to the country next month. This is part of Beijing's efforts to boost people-to-people exchanges and showcase the, quote, real China. They will enlist influencers with at least 300,000 followers to collaborate with Chinese content creators. That's your Bloomberg Brief. John?
Recruit them into the propaganda machine. Yahara, call it what it is. Up next on the programme, the Morning Calls Plus, Ben Kallo of Baird on his downgrade of Tesla ahead of its robo-taxi test later this week. That conversation's up next, live from New York. You're watching Bloomberg TV. The open in about 1 hour and about 12 minutes away. Equities into that positive by 0.2% on the S&P, up by 0.2% on the Nasdaq 100. Those of you just joining us, welcome to the program. If you're tracking trade talks between the US and China taking place, day 2 over in London at Lancaster House. They've just taken a lunch break. That's going to reconvene again in about 40 minutes time. So 2 p.m. local. Look out for that a little bit later. Let's get you some morning calls. First up, Redburn, double downgrading McDonald's to sell, saying weight loss drugs are suppressing consumer appetites. That stock is down in the pre-market by 1.2%. Your second call from Loop Capital, raising its price target on Disney to $130, citing a more stable environment as it gains full control of Hulu and keeps putting up prices. Stock is down by 0.5%. That's me editorializing. You see how expensive Hulu is now?
I don't have it for that very reason, so yeah.
Getting more expensive. And finally, UBS reiterating its neutral rating on Apple, noting a lack of AI announcements at its worldwide developers conference. That stock is down by about 0.1%. Let's stick with the Mag 7. Tesla set to unveil its long-awaited robo-taxi on Thursday. Ben Kallo of Baird downgraded the stock to neutral rating. We believe Musk's comments regarding the robo-taxi ramp rate are a bit too optimistic. This excitement has been priced into shares. Ben joins us now for more. Ben, welcome to the program, sir. Appreciate the update from you off the back of this call. Ben, I want to say up front, you are constructive over the long term on this name. Just walk us through why the change now.
Yeah, I didn't want to make it about the spat or dispute between the president and Elon Musk. This was something that, we had contemplated for quite a while. I do think that, the valuation has got ahead of itself around robotaxi. It's a very big event for Tesla. It's been in the works for a long time. I do think that two things, it's going to be higher competition when you get out there, Waymo, others. I do think the rollout will take longer. I do think that at first it will require more people. So people in control centers, making sure that the cars don't get into accidents if there's something like that. And so the economics will not be as good as they could be over the long term. And so I think that, as we get through this, the hype dies down and it becomes reality, and rolling this out will be very difficult. Not to say that Tesla's not done very difficult things in the past. I think there are other risks, though. I mean, key person risk outside of the president and Musk's spat. I think that retaining talent is something that I worry about. We did see the head of the Optimus program leave recently. The best thing about Tesla is their employees, innovation there. I think they'll always be able to recruit very strong engineers. This makes it a little more difficult. And then just very near term, I do think that numbers are too high for deliveries. We're seeing, a lag in all auto sales, but, with Tesla and, the brand damage that has occurred in different regions, I think that that's a risk as well. And then we have tariff risk, and we can go on for other risks as well. And so we thought it was time to just go to the sidelines for now. We do remain constructive in the long term. Short, intermediate term, though, I think there's downside to the stock.
So, Ben, let's unpack some of this. So 3 buckets of risks. We've got lofty expectations, key man risk, and competition. Ben, can we just sit on competition for a beat? Where is the competition coming from? Who do you worry about?
Well, in China, I think is the most fierce competition on the electric vehicle side. In the United States, I think that the ride-hailing robo-taxi service is going to have competition from the likes of the incumbents of Uber and Lyft to Waymo to others. There are several other companies out there. Amazon has a company that is working on autonomy as well. And so I think that the economics will not be as lofty as some people think. Additionally, it is also a consumer product. And so when we worry about brand damage for vehicle sales, you have to wonder about any kind of brand damage when you start getting into a car without a driver. And then third, in Europe, I think you have a host of competition, and lots of bears over the years have talked about competition, and it hasn't really gone anywhere. But now you have the likes of BYD selling into Europe. Tesla sales were better in the last month than BYD, but BYD is catching up with them. And then you also have Germany that are making a big push for their domestic OEMs, auto manufacturers, giving some types of credits or breaks on their cars to try to catch up with Tesla as well. And so you kind of have it coming in all different directions right now.
On the driverless vehicle side of things, we also learned this morning that Uber would be partnering up with a company called Wave to try to launch robo-taxis in the UK. Ben, a really tried and true business model for tech had been prove it works in America and then export it abroad. When it comes to a robo-taxi for Tesla, is that option, is that business model for growth not as available to them because of the brand damage you've been talking about?
I think it is. And I think one thing, about the key person risk and Elon, this double-edged sword. I remember, during the Biden administration, Elon gets on a plane and goes and meets with Xi, and just out of the blue. He had, his reach stretches very far. I think that, there are difficulties in China about data. They have made progress there. Europe is a little more, the EU is a little more bureaucratic, I think, and more difficult, like a patchwork, to get approval there. In the US, one of the fundamental things that the relationship between the Trump administration and Musk had going for it is to try to have a blanket federal rule about advancing autonomy versus the patchwork state way that we have it right now. So I think they'll be able to move, outside of the United States in this. I think it takes time. One of the advantages they have is they're going for this all visual, all camera approach versus, much higher cost for a Waymo. A Waymo vehicle costs over $200,000. And so it's much more capital intensive. There's still a big debate whether, Tesla's approach will work in the long term, but that remains to be seen.
Ben, just before you go, I know you don't want to make the downgrade about the spat between Elon Musk and the president, but I'd love a comment from you on that. Do you think we made too much of a big deal of that about what it means for the stock? What was your general reaction to how that played out?
Well, I think it's bad for our country. And I love our country. And I think that, being public in this dispute like that, and it got pretty racy. I don't think that's good for anyone. Tesla, SpaceX, Elon's other companies, some of the most, if not the most innovative companies in our country right now. And, getting, down and dirty in the sandbox doesn't do anyone any good.
It's hard to disagree with that, sir. Ben, appreciate your time this morning. Thank you. Ben Kallo there of Baird. Tesla in the pre-market doing a little bit better, positive in early trading. Up next on the programme, we'll catch up with Matt Luzzetti of Deutsche Bank with key inflation data due out this week and why Matt Luzzetti means maybe this economy has maybe adapted to interest rates of 4.5%. We'll get into that in just a moment. Live from New York, you're watching Bloomberg TV. The opening bow 60 minutes away. Equity futures on the S&P 500 positive by a little more than 0.1% on the S&P. Similar move on the Nasdaq, higher by close to 0.2%. With 1 hour until the cash open. With your morning movers, let's get back to Yahira. Hey, Yahira.
Hi, John. We start with J.M. Smucker. Those shares are falling 8%. The packaged food company just reported results and profit forecast disappointed. This is because the company behind Folgers Coffee and Jif Peanut Butter said tariffs are hitting its coffee business and consumers are pulling back. Yet despite that consumer hesitance, it still plans on raising prices. We'll see how that works out for them. But one bright spot at the company that they did mention is that apparently Uncrustables are flying off the shelves. Not the same enthusiasm for McCrispy chicken strips at McDonald's, our next stock, which is down 1.3% after it was hit with another analyst downgrade this morning, this time by Redburn. Yesterday, it was Morgan Stanley. And then there was Loop Capital, which flagged that people were complaining about those McCrispy chicken strips, saying that not only were they smaller, they also had less bread. So they also cut their rating. And turning to something outside of food, because I'm getting hungry, we turn to Meta Platforms. Those shares are up 1%. And this is as we here at Bloomberg report that CEO Mark Zuckerberg is apparently frustrated with their chatbot models. And because of this, he is personally building a secret super intelligence team, even holding recruiting events at his homes in Palo Alto and Tahoe as he tries to assemble the best of the best to try and achieve artificial general intelligence. John?
Yahara, thank you. Thank you very much. 3 of the movers to look at going into the opening bell about 60 minutes away. Later on this afternoon, we start working our way through some debt supply. 3-year notes, $58 billion worth. On to tomorrow, 10-year notes, $39 billion worth. After that, $22 billion of 30-year bonds. Of course, all of this taking on additional importance after the tax bill advanced through the House and onto the Senate and all the debt concerns over the past few months or so. That's the debt supply story. Also some economic data, a double dose of inflation data this week. CPI due tomorrow, PPI after that. Mike McKee has more for you. Good morning, Mike.
Good morning, John. I'm going to say something you haven't heard me say in a while, and that is that the CPI report tomorrow could actually be important to the markets. Not going to change what the Fed is going to do next week, but we may get our first clues as to some tariff pass-throughs to consumers as companies try to deal with the uncertainty and the tariffs that we have already seen. The consensus is we're going to see a rise on a year-over-year basis in both the headline and the core. It's the first increase since January. The survey, though, says the risk is to the downside. If there is a surprise, it may be a little bit less inflation than we anticipated. But we will be parsing all these categories for tariff effects. The pass-through is expected, at least according to Bloomberg Economics, in food at home. Yahira mentioned getting hungry. Grocery prices are down, according to the USDA, which does its own monthly survey. Furnishings, apparel, electronics, all those are imports that we could see higher prices feed through into, and used in new cars because of the tariffs that the president has put on automobiles. On the other side, we have declining gasoline prices and natural gas prices, so energy could be lower. Core services could be lower as well. Airfares and lodging probably have fallen because travel has fallen off. So those are things to watch tomorrow. There's one other thing that all the Wall Street economic nerds are going to be watching, and that is the Trump pass-through to the survey itself. Because the Bureau of Labor Statistics had to let go people and people have quit, it did appear last month like the survey had a larger than expected response rate because perhaps they dropped some survey places from the list. And that would require them to impute more prices than actually getting the specific price levels. So there may be some questions about the data tomorrow. That's something to keep an eye on.
Mike McKee, thank you, sir. Could be the calm before the storm. Mike McKee, thank you so much. Matt Luzzetti at Deutsche Bank is with us around the table. Matt, good morning.
Good morning.
It's good to see you, sir. Let's talk about whether it's too early to see that kind of inflationary impact from the tariffs tomorrow or not. Is it?
So I think from a broad-based perspective, it likely is. I think if you look back to the previous CPI, you began to see it showing up in some of the data points. But that's been offset by some of the discretionary services items where we've seen weakness, such as airfares. You saw it in the PPI data last month, and it typically takes a few months for that really to begin to show up into the CPI. And so our baseline expectation is you get a little bit more evidence of it in tomorrow's print, but really it takes the June, July, and then August data to get stronger evidence of tariff pass-through.
What would you need to see to say, you know what, I think this could be sustained, this could be sticky, it's not a one-off shock?
So I think it's going to be hard in this environment. I think typically if you go back to what we saw of the post-COVID environment, initially, there was this view that it might be transitory or temporary. And that view was dominated by the fact that it was narrow on a few items, used cars, other core goods at that point in time. I think to think about it being stickier, you want to see it broadening out across the basket. So probably not just in core goods items that you can readily identify for tariff effects, but other items. So, for example, as you get vehicle tariffs, you're likely to see car repair pick up with some lag. Car insurance inflation is going to pick up alongside of that. I think those are the effects that you'd want to see to get some sense that it's a little bit stickier than anticipated.
There was an expectation that in this 90-day pause with China that you'd see a lot of shipments come in, that people would front run it, make the data messy, et cetera. We haven't really seen that. There hasn't been a lot of action in the ports. Is this still an economy in suspended animation, and when does that change, if so?
I think for a lot of ways it is. Now a lot of this, halting or stalling out is just give back for surge in imports that we had in Q1. And so particularly in the trade data, you've had this massive volatility where net exports were very weak in Q1, are going to be very strong in Q2, lifting the GDP data. But I think the market kind of understands that. I think but we're now in an environment of where's the pass-through to the other components of especially what the Fed cares about. The labor market, are we seeing layoffs take place and hiring dip? So far, I think the answer is not yes. Last week's jobs report was mixed but resilient enough, I think, for the market. And then secondarily, when we begin to see it in the inflation data. Again, I think we've seen it in the PPI data so far. Still waiting to see it for the CPI. We're not surprised that you haven't seen it yet. Our baseline expectation, if you go back to 2018, 2019, is that it was always going to take until the June, July, and August data to see the effects.
I just want to flag some of the language you used. When you asked, has there been weakness in the labor market, you said not yes. You didn't say no. Are there pockets of weakness that you're looking at that you're concerned might bubble up into something more concerning?
I think you still have this labor market, which has been identified by a low hiring and firing environment. If you look at the JOLTS data last week, the hiring rate remains low, but layoffs remain extraordinarily low as well. That's always been a fragile equilibrium. Now, nothing has broken. That equilibrium has persisted. But there was worries, at least initially, that the tariff shock, the uncertainty that's come along with it, if financial conditions were tightening, that could lead to the layoffs that could kind of break that fragile equilibrium with the labor market weakening more materially. We didn't see that last week, but I think that's still a risk as you look ahead.
You mentioned something in a recent note about interest rates maybe stabilising around 4 to 4.5%. Can we sit on that story just for a moment? Because I thought it was a fascinating note. Do you think we've fully adapted to an interest rate with something close to 4%? And what does that tell you about how much this Fed might cut if we see some weakness down the road?
Yeah, so I think the main chart of that piece was showing, if you look at where the Fed funds rate has been, we've been at 4.3% since December. If you look at headline PCE inflation, at least, it's at 2.1%, basically within spitting distance of the Fed's target. And you look at the unemployment rate, we've been stuck at 4.2% for several months at this point. That 4.2% is exactly in line with what the Fed thinks the long-run unemployment rate is. And so if you look at that chart, it looks like you've settled into what economists would call a steady state for the economy. It actually looks like you've simulated the economy through a model where you're at kind of equilibrium and everything is working its way out. Now, we've been in the high R-star camp for a while. We pegged at the nominal neutral rate between 3.5 and 3 3/4. So we've always expected this cutting cycle to be shallower. But we're just proposing the possibility that there's not much evidence that we're very far away from neutral at the moment.
This conversation was kicked to the sidelines because of the tariff story over the last few months. I get all that. But is the Fed moving towards you? Do you see the Fed moving closer towards you in the coming meetings?
I think so, and we'll get maybe some evidence of that next week. We'll get the dot plot next week where I think there's broader expectations that the Fed will signal a more hawkish stance. We'll be looking at the long-run dot. Does that continue to migrate higher? My guess is that it does. So they've been at 3% for the long-run nominal neutral. That probably continues to move higher. I think the balance of estimates that we look at are kind of closer to 3.5%. But I think to really fully embrace the idea that neutral is materially higher, you have to get beyond the tariff concerns, the uncertainty shock that we've had, and have a labor market that still looks resilient 3 to 4 months ahead.
Since you took us to next Wednesday, let's sit on next Wednesday. How useful is the rest of the SEP from the Federal Reserve?
I think it's an environment where, Chair Powell likes to, I think, downplay the signal from the SEP when it's kind of convenient. This will be an environment where it's probably very convenient. I think the market will, if they only show one cut next week, which I think is broadly anticipated, the market will move to what do next year's forecasts show. Does inflation rise a little bit? Are they showing some stickiness there? Are they showing less cuts through next year? I think that could signal kind of a more hawkish stance, but I would also anticipate that Chair Powell kind of tries to walk that back in the press conference. I think they don't know, we don't have huge confidence about what policy is going to do this year because there's still tariff-related uncertainty, fiscal policy uncertainty, a view towards next year about what policy is going to be.
He's not going to be there through much of 2026. Does that complicate signaling at the top of the Federal Reserve?
I think for now, they're kind of more focused on the near term. And so they're sending a strong signal that they're in a wait-and-see mode, that they're well-positioned to respond to risks. And I think that signal will continue. Certainly over the summer months, as perhaps you get some evidence of who President Trump may appoint to the board, I would expect that in replacement of Governor Kugler in January, that could be the next potential Fed chair, certainly the market focus will shift to that.
Matt Luzzetti of Deutsche Bank. Matt, appreciate the time. Looking ahead to inflation tomorrow on Wednesday, then a week tomorrow, we get that Federal Reserve meeting, we get the statement, a news conference and an update to the summary of economic projections as well. If you are just joining us, welcome to the programme. Equity futures almost totally unchanged through most of this morning. A bias to the upside over the last month or so. Again this morning up by something like 0.2%. With an update on stories elsewhere, let's get your Bloomberg brief with Yahara Anand, who has more. Hey, Yahara.
Hi, John. Trade negotiations between the U.S. and China are continuing for a second day in London. The U.S. signaled a willingness to remove restrictions on some tech exports in exchange for assurances that China will ease limits on rare earth shipments. Treasury Secretary Scott Bessent said they had a good meeting yesterday, and Commerce Secretary Howard Lutnick called the talks fruitful. Meanwhile, here in the U.S., Health Secretary Robert F. Kennedy Jr. dismissed all 17 members of a key federal vaccine advisory panel, accusing them of conflicts of interest. Before joining the Trump administration, RFK Jr. was known as a vocal critic of the committee, which advises the director of the CDC and helps shape national public health guidelines. And Apple unveiled the most sweeping redesign in its history at its Worldwide Developers Conference. The design, called Liquid Glass, will unify user experiences across all devices from iPhones to MacBooks. As part of its rebranding efforts, the company also confirmed that it will use years, not version numbers, to identify its software. Less confusing. That's your Bloomberg Brief. John?
Yahara, very much so. Yahara, appreciate the time as always. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Thierry Wizman of Macquarie with key Treasury auctions coming up. 10-year supply, 30-year debt too. Plus, the conversation continues in London, negotiations between the US and China. We'll touch base with Annmarie on the ground in Britain's capital in just a moment. From New York, you're watching Bloomberg TV. The cash open, the opening bell about 44 minutes away. Equity futures into that just about positive by close to 0.2% on the S&P, and the Nasdaq a similar amount higher, up by 0.17%. Bit of a snooze in the equity market through most of this morning. In the bond market, things could get interesting tomorrow. 10-year debt, day after 30-year supply. This morning, yields come again down by 2 basis points, 4.45, close to 5% still on 30s. Danny at 4.91. Tony Rodriguez of Nuveen on a program earlier. Nothing to see here, nothing to worry about.
I think there's a sense that, hey, that's a pretty attractive yield. Yes, there's some volatility there, but perhaps we look back at this period and say around 5%. That was the buy of a lifetime. So you have an auction coming up. Maybe that's enough not to entice really outsized demand, but enough demand that we don't get worried about it.
More on treasuries in just a moment. Still close to 450 on a 10-year maturity. Looking ahead to those debt auctions. Also looking ahead to this as we count you down to the opening bell. Your trading diary is shaping up as follows. Today, the US and China holding trade talks in London. Day 2, that continues. Tomorrow, CPI data plus. Treasury Secretary Scott Bessent testifying on Capitol Hill. He's in London right now. On Thursday, PPI and another round of jobless claims. And Tesla's robo-taxi launch over in Texas. And then going into the weekend, another read on that political survey. The political poll that is now the image sentiment, consumer sentiment survey. Day 2 of trade talks very much underway between the US and China earlier on this morning. Annmarie joins us now from London with more. They broke up for a lunch break, Annmarie, just moments ago in the last hour or so. What's left to negotiate for the day ahead?
Well, it's a great question, Jonathan. There really is no update here because after more than 6 hours of talks yesterday, 2 hours this morning, they did break for lunch. They should be reconvening around 2 o'clock local, so just in the next 15 to 20 minutes or so. We still don't have an agreement in place. And the last we heard from the president was that China is difficult to deal with, and he kept it pretty open-ended on how much he was willing to lift and ease some of those export controls, especially when it comes to advanced semiconductors. So we're still waiting to hear on what the update is. We should remind our audience that whatever we get out of this was really about reigniting confidence between this relationship after just about 10 days ago, the Treasury Secretary felt that talks stalled between China and Washington. And this had to do with what they agreed upon in Geneva. The United States wants to see a more accelerated pace when it comes to the licensing of rare earths and magnets. And what China wants is the easing of those export controls. But really, how much is the U.S. willing to give in? Will it be the most recent export controls or are things like the H-20 chip on the table? Kevin Hassett says they're not. But let's see what they come out with today. Talks still ongoing at the moment.
Annmarie, a theme for us so far this morning, just a reminder of the bigger picture, how long it took to secure a phase one deal in the president's first term. I remember things getting hairy in July of 2018. It took 18 months to sign that phase one deal in January 2020. And then we got into the pandemic, and then that phase one deal was quickly forgotten about. How different are things going to be this time around?
Well, trade talks, trade deals take a lot longer. They take years, not days. We're in the first inning of this relationship in Trump 2.0. To your point, Jonathan, Trump's first administration, and we were talking about a purchasing agreement that started in 2018 and it ended in 2020. That was a purchasing agreement. When you look at the contours of what they are discussing at the table for this agreement, there is a whole host of issues and potentially different tools in the toolbox that the United States and the Chinese are going to use. At the table today, we're just talking about really rare earths and export controls. And now you have national security taking center stage. So actually, Trump 2.0, the negotiation seems even more complicated than during his first administration.
MH, Annmarie, we're still hopeful we get you back in the studio tomorrow morning. I know the flight is booked later on this evening. Let's see if this wraps up in time.
Me too.
Annmarie from London, thank you. We're also keeping one eye, a few eyes, both eyes on Treasury auctions tomorrow. 10-year notes, 30-year notes, all coming up over the next couple of days. Terry Wizman of Macquarie joins us now for more. Terry, good morning to you.
Good morning, John.
Should we worry about 10-year and 30-year supply?
We should worry a little bit more about the 30-year auction. I think the pattern in the last few months, based on what we've been seeing out of the indirect bids and purchases, has been that foreigners are stepping away a bit from the long end of the curve. We've actually had strain from indirect bids at the shorter end of the curve. What that tells me is that foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they lost some confidence in the ability of the U.S. to manage its deficit. I think these are all part and parcel of the narrative around why the 30-year yield has gone up as much as it has in recently.
The price surely matters. Does 5% help? Does 4.90 help on a 30-year?
So what I tell clients is that if you look at bond deals, there's really two approaches here. There's a cyclical approach, and based on the cyclical approach, on the presumption that global growth is slowing, on the presumption that U.S. growth is slowing over the next few months, in part because of the tariff shock, you should expect yields to come down. From that perspective, even the 4.50 we're seeing on the 10-year has room to come down, maybe down to 4.25%. But I think from a longer-term perspective, 5% may not be enough, or 4.5% on the 10-year may not be enough. We may have to see higher yields to equilibrate demand and supply in view of a lot of things, a lot of narratives, a lot of trends out there that are inflationary and tend to move people away from a willingness to buy nominal assets like U.S. Treasuries. What are those tendencies and trends? It's deglobalization, it's demographics, among two important ones that are going to tend to produce some inflationary pressure, not just for the U.S., but for the world over the next few years. And from that perspective, it's I'm not saying that the 30-year should go to 7, but I think we're only seeing the leading edge of the nervousness that's coming with the realization that we may be stuck in a higher inflationary regime going forward.
So if it's not 5 and it's not 7, where is the level that makes sense in this environment that you would be more willing to dive in?
So a lot of this depends on whether or not people's perception of the deficit in the U.S. is going to remain adverse and pessimistic or optimistic. It's a little too early to say, in part because we don't know whether or not the Senate's going to push back on the House's bill. But let's say the Senate does not push back on the House's bill and there is more nervousness about long-term supply. I can certainly see the 30-year moving higher in yield.
Torsten Slok yesterday argued that it's an issue that you have half of the fixed income being issued from the government, that it crowds out other investment for both consumers and corporates. Is that a real problem when you have so much of the issuance skewed towards government debt instead of corporate debt?
In a country like the United States, where savings rates are relatively low compared to other countries, and it's difficult to motivate more savings out of consumers and businesses, I would say yes. the more issuance there is, the more likely there is going to be pressure on upward yields. And yes, to some extent, this will crowd out private investment. That doesn't mean that what the government does with its money has a lower rate of return, and therefore we should promote necessarily private investment at the expense of whatever the government is doing with its money. But yes, to the extent that yields are higher, there is crowding out. It's more or less standard economic theory at this point and accepted by the markets that more issuance you have, the higher yields will be. And of course, it's not just the supply issue. There is the risk premium as well, right? We've seen sovereign CDS spreads in the U.S. move to 58 or 55 basis points. It's now rivaling Greece. I think to some extent that reflects nervousness about the fiscal outlook. And yes, that's an aspect beyond supply, of course, of the U.S.'s fiscal outlook.
You're in a great seat because you don't just cover interest rates, you cover foreign exchange as well. I'd love your view on the FX part of this. You talked about foreign investors maybe leaving behind the long end of the curve and shortening up duration and coming into the front end. Some of them just worrying about foreign exchange and pulling out of dollar-denominated assets wholesale and retreating to domestic markets. Now, price action shapes narrative, it also reinforces behaviour. How much of that just becomes self-fulfilling, that people start to see this dollar weakness and it just accelerates those moves in months to come? Things seem to have settled down now, but do you expect to see bouts of this in the year to come?
But that's a technical argument. It's a technical description of what can happen in the FX market. I tend to lean more on the fundamental outlook. The fundamental outlook is not necessarily good for the dollar. In fact, I would say it's adverse for the dollar because we're coming off a 12-year period of dollar appreciation in real terms. I keep repeating this to everyone I see. If you look back to 2012 and you compare it to end of 2024, we've had a 40% real appreciation in the value of the dollar. So we're starting from a situation where the dollar is rich. We're also starting from a situation where people all of a sudden are very much concerned about policy uncertainty emanating from the U.S. And I think that's going to be an important driver of perceptions around the dollar. The dollar's brand value has certainly faded over the last few months, in part because of the uncertainty, the abruptness, the aggressiveness, the pugnacity of policies coming out of Washington. So I think we're on a long-term downward trend for the dollar. It doesn't mean to say, of course, that there aren't a certain class of investors that are inclined to buy on the dip. I would not necessarily be one of them. I'd keep my eyes on the next 2 to 3 years.
Terry, appreciate your time.
My pleasure, John.
As always, thank you, sir. Terry Wizman there from Macquarie. Looking ahead, some key economic data points, and I'm not talking about CPI and PPI. We're talking about 10-year auctions and 30-year debt supply. Coming up tomorrow, we'll catch up with Torsten Slock of Apollo, Bob Diamond of Atlas Merchant Capital. We'll speak to Seth Carpenter of Morgan Stanley, David Kelly of JPMorgan Asset Management, and Danny's off to California, right?
I am. Off to LA to cover the Bloomberg Credit Forum with Lisa. So we'll be hand in hand. Sorry to leave you alone around the desk, John.
Looking forward to the coverage. Hopefully, I said it earlier, hopefully Annmarie makes it back in time for the programme tomorrow morning. She'll be covering the talks in London between the US and China. From New York, thank you very much for choosing Bloomberg TV. It's a quiet start to the week. It gets busier tomorrow morning as we look ahead to CPI data. From New York City, this was Bloomberg Surveillance.